Hello everyone and welcome to QuintEdge. Dhruv Rahul this side. I am an ACCA affiliate and in this video you will get a comprehensive coverage of audit and assurance paper. So what I suggest is while you are watching the videos, do make notes along with me. So like you are pretty much covered with all the important areas of your exam and also start practicing with whichever materials you are referring to. So yeah, all the best for your exams. See you at the classes.
So the paper that we are concerned with is audit and assurance. All right. Now the thing particularly different with this paper is there is performance management, FR, FM. They follow a certain pattern skill level में कि FR में कैसा होता है? How is it like in FR? Financial reporting में you have section A, section B, and section C. Okay. So under section A, you have 2 marker MCQ, 15 MCQs of 2 marks each. So total 30 marks for section A. Section B, you also have 15 MCQ, but these are divided into 3 cases. So 5 MCQs in each case, all having 2 marks. So total 30 marks here. Okay. So 30, 60 you got here. And section C is subjective type question, constructive response question. You just spreadsheet, you use spreadsheet and word file in that case. So there you have 20 markers, 2 question. Okay, so 40 marks here. All right. So this is the pattern that is followed for PM, FM, and FR. Okay, total 100 marks. And as you know, you require 50 marks to pass. Okay, so this was the case. Now, how double A is different? Double A is structured in such a way that you have 2 sections. Section A. Okay, so under section A, similar to MCQ type, so there are 3 cases, 5 MCQ for each case, and of 2 marks each. Okay, so total 30 marks for section A. All right, this is MCQ. Now comes the real deal, the section B. Here you have 3 constructive response question, one of 30 marks, other of 20, 20. Okay. So 30, 20, 20 total 70 marks for section B. Okay. And 30 for section A. So this is how it is structured. And as you know, AA has the lowest passing rate in terms of skill level. Okay. So definitely we are going to tackle that, how to deal with as an okay. It's not at all, numbers are not like that. It could be all of you might be passing, the others might not be passing. So number is an average from all the students giving the AA paper. So don't let that passing percentage let down your confidence. Okay. So 30 marks from your MCQs and 70 marks constructive response question. This is why most probably they have less passing rate. Okay. Because here you can gather more marks with MCQs and 40 marks are for constructive response question. So any doubt till now with the paper pattern?
No, sir.
No, sir.
Okay, yeah, great. Now we'll just deep dive into the introduction of audit, a holistic framework on of what exactly audit is. Not going through the PDF, not going to through that bluff. Okay, there is this PDF, the introduction chapter. That's gonna be boring. So let's just tackle it. So in layman terms, can someone tell me what comes to your mind when I talk about audit? Hmm? Yeah, in layman terms. Not the technical definition that you might have heard, just the layman terms. What comes to your mind when I say audit?
Checking the accuracy of financial accounts of an organization.
Okay, okay. This is kind of a BCom definition, I believe. Huh?
Yes.
Yeah. Yeah, okay. So I'm just asking from a layman's terms, just someone who might have
Examination
done
of
to,
records. Yeah.
yeah, could be. But someone who has done, science, took science since 12th standard, at layman terms, a common person, how would he infer audit? In layman terms, many of us do look at audit as checking, yes or no? Ki we have done an audit, quality audit, so on and so forth. We have done this audit. So in layman terms, can I say people usually interchangeably use ki, okay, audit has been done. So someone might infer it as, okay, a check has been done. Yes or no?
Yes, sir.
Yeah. So now let's just jump into our ACCA curriculum. So before that, I'll tell you one story. Okay. What used to happen previously? Let's say previously, I mean in the 1800s, in the 1850, when the economy was not this complex, we were not international trades were not happening globally. Simple, I'll take one example. Previously, what used to happen? Let's say I run a business. Okay. So if I run a business, I do trading, for example. If I'm doing trading, then what's gonna happen? I'm gonna sell goods. Simple transaction, a business transaction. I'm gonna earn revenue from selling goods. Okay, revenue from goods. I'll be incurring some cost. Simply in today's terminology, it's called cost of goods sold. Then I'll be preparing my profit and loss account. Okay, then I'll come to know okay, how much profit did I make. Okay, this is earlier times. Okay, we're not gonna get into the complications of tax and so on, but just for understanding, I'm doing a trading business. If you notice it closely, I am the one owning the business. Okay, and I am the one managing the business. Okay, so do I have any incentive to manipulate the accounts? Tell me yes or no.
Sir.
Do I have? Can I do fraudery with myself?
No, sir.
Yeah. So this was everything going on. Okay. For a lot of years, the businesses were simple. But then what happened as time went by? Companies became public. So there are a lot of shareholders now. Okay. So are all the shareholders involved in the management of business? Yes or no?
No.
So do they know all the nuances, what's happening in the business?
No.
Okay. So this particular here is called an agency relationship. How is it called an agency relationship? Let me just take you through this. See, there are shareholders and investors. Okay. They put in the money, they put in their capital. And now it's not at all practical for them to involve in the day-to-day running of the business because many a times even you have, let's say our investment is not at all significant. Let's say even if you have invested in any of the shares, would you be sitting at the board? Even if you have significant investment, would you be sitting at the board?
No.
Okay. So there are a lot of fragmented shareholders, but still they cannot, even if they have majority shareholdings, let's say 30%, 20%, this is all not possible for them to get involved in the day-to-day running of the business because it might be an investment for them. Okay. So there are shareholders. So how do we tackle that problem? They hire managers. On an audit terminology, that's called management And the board that we talk about, the board, there is audit committee, there's a chair, the board meetings that happen, that's called those charged with governance. All right. So this is how the arrangement is made. I'm a shareholder. I cannot be involved in the day-to-day running of the business. So that's why I appoint management and those charged with governance. Okay. So now they will run the company. Here, the shareholders, they are the principal, and the management and those charged with governance is the agent. So that's why this is called an agency theory. All right. So they will run the company. Now, let's say, for example, you are out for a vacation and you entrust, okay, you gave your keys of your home to your neighbors. Okay. So basically, what you are doing, you are entrusting your neighbors with your assets. In this case, it's a flat. Tell me yes or no.
Yes.
Yeah. So basically, that's called stewardship. Now, in this case, shareholders, they are entrusting their assets, particularly the company's resources, basically the company's resources, to the management and those charged with governance. So here there is that it's called stewardship. Okay. So agency theory and stewardship. So don't you think management and those charged with governance, particularly the management, here in audit, management is responsible to prepare the financial statements.
Could you
Statements.
please repeat the definition of stewardship?
Stewardship is nothing but when shareholders entrust their company resources to management. That's basically stewardship. Stewardship is not a particular definition, it's a concept. Okay. So in this case, there is a stewardship agreement between the shareholders and the management. Got it? So management is responsible to prepare the financial statement. All right. And those charged with governance, keep in mind, they oversee management. Okay. And are ultimately responsible to the shareholders. All right. So this is how the scenario looks like. So don't you think management, when they are given the task of preparing the financial statements, now you know from accounting perspective, a lot of manipulations can be made. Agree or not?
Yes,
Yes.
sir.
Yeah. So let's say a management actual profit is $800,000 and management reports it as 1.2 million dollars. Okay. Now you might ask how it's called creative accounting. You might not book the expenses which were required. Okay. So that's how you basically boost profits. A lot of ways are there. Okay. So, and why management would do this? They have an incentive. Why so? Because their bonuses might be based out of company's performance. And how are you going to show company's performance better? By better profits. Okay. So don't you think that there is a conflict of interest between the management and shareholders? Tell me.
Yes, sir.
Yes.
Yeah. So due to this conflict, this particular scenario, the thing that's playing out here, stewardship concept, the management is entrusting the management, sorry, shareholders are entrusting the management with their assets. Okay. Stewardship, there's the agency relationship. Now, there is definitely a need. And before we begin, I'll tell you a lot of big scandals happened in America. The Enron scandal. Have you heard about Enron? The estimated loss that it made was around 90 billion, not even million, it was billion. Okay. So how did it happen? It scaled out all because of audit failure. Okay. Manipulation kept on happening. The investors were in a bubble, and finally, when the misstatements, I mean the fraudery came out, then all these regulations were strong in US. Enron was based on US. Okay, so that's why management was held liable for their fiduciary duties if they fail to do so. So after this, Sarbanes-Oxley was introduced in the US. Okay, so Sarbanes-Oxley and US uses GAAP, generally accepted accounting principles. Okay, now GAAP is rule based, and our ACCA follows IFRS, and for audit it follows ISAs. Now, if you have done FR, you know IFRS are principle based approach. Okay, so yeah, rule based, which means if the rule states that it should be 89%, it should be 89%. So there are a lot of loopholes happening out there, but principle days simply says, okay, if substantially something is happening, so yeah, you can follow that, but you have to, follow substance over form. So for example, I am having preference shareholders. As you know, if you remember IFRS 9, okay, it was in FA. So if you know preference shareholders, if they are redeemable, they are treated as debt. Tell me yes or no. Madhav, remember?
So,
Hanji.
sir.
Yeah. So this is principle based approach. All right. So yeah, there exists a problem. Because of this, we need audit. Now, what is audit? What's reasonable assurance? What are all these words? See, there's a three-party relationship. There are responsible parties, and then there are intended users. First, we'll talk about intended users. Who are the intended users? Investors, lenders, potential investors. Because even if you want to invest in any companies, what are you looking at? If you are doing fundamental analysis, you are looking at what? Financial statements of that company and whatever brokerage app you prefer, right? So potential investors. Okay, so these are all intended users of what? Financial statements. Okay, so now, as we discussed, they are not involved in the day-to-day running of the business, so that's why they appoint managers and those charged with governance. Management, those charged with governance. All right. So they are responsible parties. Responsible parties for what? For the preparation of subject matter as per the set criteria. Oh, what is subject matter and what is set criteria? See, here in this case, the subject matter would be financial statements. Yeah, the financial accounting and the set criteria. This is nothing but appropriate financial reporting framework. Okay. So what is management responsible to? To prepare the financial statements. Now, how are they going to prepare the financial statements as per appropriate financial reporting framework? If it's an international company following IFRS, how are they going to prepare their account as per IFRS and IAS? Okay, so in that case, the appropriate financial reporting framework would be IFRS and IAS. Okay, International Financial Reporting Standards and International Accounting Standards. Okay, the IAS are the bit older one, IFRS are the newer ones. Okay, now if it's an Indian company, what would be the appropriate financial reporting framework? Ind AS. Okay, if it's an American company, what would be the appropriate financial reporting framework? GAAP, Generally Accepted Accounting Principles. Okay, what are we concerned with? IFRS, because ACCA follows IFRS. Okay, so they have to prepare the subject matter as per appropriate financial reporting framework. So in this case, the responsible parties, what are they going to prepare? Financial statements of the company. How are they going to prepare? As per the financial reporting framework. Okay, so what's the role of an auditor in this case? As we have discussed, there's a conflict of interest between intended users, we've talked, investors, lenders, shareholders, and the responsible parties who are responsible for the day-to-day running of the business and responsible to the preparation of financial statements. Now you can imagine the importance of financial statements because most of the important investing decisions are based on that subject matter. Here in this case is financial statements. Now intended users want an assurance over the matters provided by the responsible parties. Here in this case it's financial statements. So for them they are going to hire a practitioner. Okay, and here in this audit and assurance, here the practitioner is an external auditor. Okay, this is where the auditor comes in play. Auditor is not an employee of the company. No, he is an independent auditor. Okay, and there is no scope of conflict of interest, a very less scope of conflict of interest because they are billed by the hours. Okay, they do the work and they are paid accordingly. Okay, so they don't have a lot of factors are involved. We'll talk about it in the ethics part. Okay, what are the self-interest that what are the potential threats to the code of conduct of an auditor? Why do we trust an auditor? All those would be discussed further in coming classes. But yeah, here the intended users, the shareholders, keep in mind, are going to properly appoint a practitioner. So is it going to be like the shareholders sitting at the table? They're going to say, okay, this is the auditor that I like and I'm going to appoint that. No, it's not like that. Management, they will refer, okay, they will refer an auditor, like an external audit firm, to the those charged with governance. See, management, those charged with governance. Now, those charged with governance is particularly a board. Now, board has an audit committee. Audit committee is made up of non-executive directors. Now, it is a bit of corporate governance territory, but I'll just tell you briefly that audit committee has non-executive directors, and non-executive directors are pretty independent because they are not the employees of the company. They get their remuneration by sitting at the board. Okay, so they don't have any particular incentive in recommending something wrong. So the management would suggest a particular audit firm to the audit committee. Now the audit committee will analyze it and okay, look whether the audit firm is independent for the company or not, and then they will suggest it to the shareholders. Now final authority remains with the shareholders. So did you get it? The intended users, they want to resolve, try to resolve or at least minimize the conflict of interest, and they want an external independent assurance as for what? The financial statements. That's why they hire practitioner. Okay, so are you guys clear with the particular scenario playing out here? Why a practitioner is needed, who are the responsible parties, and who are the intended users?
Yes, sir.
Yes, sir.
Okay, so let's just look at the technical definition of audit. The objective of an external audit is to express an opinion and obtain reasonable assurance. You might be asking, reasonable, why not complete assurance? Okay, why not check all the accounts? Look into that. How are they going to provide reasonable assurance? By gathering evidence. What is evidence? And forming conclusions. And then based on the conclusion, they'll finally report in an audit report. That's how they're going to provide a reasonable assurance. So there's a lot of working in on whether financial statements are prepared in all material respect. Oh, material. Might have heard this word a lot if you have been through accounting. Respects in accordance with an identified reporting framework. Appropriate financial reporting framework. In this case, we are having IFRS and IAS and the relevant law. Okay. Report. The other objective is report on financial statements and communicate as required by ISAs, International Standards on Auditing. They provide particular guidelines on how this particular scenario needs to be dealt with, and ISAs are issued by IASSBs, International Standard Board for Auditors. Okay, International Standards on Auditing. Okay, in accordance with auditors' finding. Now let's just break. What is reasonable assurance? When it comes to assurance, assurance is basically the intended users want assurance. In Hindi, we call it as आश्वासन. हमें आश्वासन चाहिए. So when the intended users want assurance, the auditor always provides reasonable assurance. What exactly is reasonable assurance? High level of assurance, but not absolute. Now you might ask, why not auditors provide an absolute assurance, let's say by checking all the accounts? See, when it comes to big companies, even if a sizable mid-sized company is not at all possible to check each and every transaction. Okay, these are called the inherent limitation of audit. Not at all possible to check each and every transaction. What does that mean? Audit is based on sampling. You'll come to know that. Okay, it's not even practical because audit needs to be conducted at a particular interval and you have a set deadline. Okay, because the financial statements needs to be issued, so you have particular, let's say, like 2 to 3 months. Okay, based on that you have to conduct an audit. So it's not at all possible to check each and every account. So let's say you give me a particular sheet, give me a particular transaction, and you ask me that okay, there are 20 transactions. That particular thing I can check and say that I am absolutely assured that nothing is wrong with this. But the amount of data is very small. So when it comes to audit, you're auditing the financial statements of a big company. Okay. And statutory audits are required by listed companies only. Okay. So it's not at all possible to go through each and every transaction. All right. So that's why these are called inherent limitations of audit. And based on the nature of the business as well, you cannot say that I am absolutely assured. The auditor is absolutely assured that there is no material misstatement in the financial statement. That's why auditor gives high level of assurance, but not absolute. That's called reasonable assurance. Okay. Reasonable assurance is found in audit engagements of financial statement. Okay. So how are they going to provide absolute assurance? As discussed, by having evidence, conclusion, report. And how are they going to have evidence? By performing procedures. How are they going to perform procedures? Based on the risk assessment they made about the company. We'll talk about the entire audit process. Okay. So that's how they're going to get reasonable assurance over whether the financial statements are free from material misstatements. So how the final wordings of the auditor is going to sound? In our opinion, the financial statements present fairly in all material respects and give a true and fair view. Talk. Each and every word we'll discuss what is true and fair view. Okay. True is basically factual. Okay. And fair is without ambiguity. Okay. Now, there is another level of assurance also available. If any company, if a small size company, just the manager wants a level of confidence on the credibility of financial statements, then they can have limited assurance. Auditors can also provide limited assurance. But the level of work would not be as much as in the audit engagements normally have, and based on that they provide reasonable assurance. When it comes to limited assurance, lower than reasonable assurance, they are called review engagements. Okay, so the auditor performs more of analytical procedures and not the detailed ones. What are those procedures? Okay, these are the big terms, or वो exams में भी mostly आते ही है definitely. So so the wording is going to sound like nothing has come to our attention that causes us to believe that the financial statements do not present fairly. If you can see, it's kind of diplomatic. Okay, that we have reviewed the financial statements, but nothing has come to our attention that makes us believe that financial statements are free from material misstatement. Okay, so this was the assurance part. If we go back to the definition, the objective of an external audit is to express an opinion. Opinion is also an important part. It's based on reporting. The auditor will give a final opinion. There are types of opinion. There is clean, unmodified, modified. We'll also look into that. Okay. On whether financial statements, we've discussed the subject matter. Financial statements are prepared by who? Management prepares. Yeah, all right. Basically, subject matter as per appropriate financial reporting framework. Okay. Now, in this case, it's IFRS. So the financial statements are prepared accordingly. Now, the practitioner here, the auditor, will give an opinion over that subject matter. Okay, so that's what opinion is. And there are different types of opinion. We'll also discuss about that. Material respect in accordance with identified reporting framework. And material. Now there is going to be one terms which is going to be staying constant throughout this subject is material and misstatement. First, we'll look into what is material. Misstatements, including omissions, are considered to be material if they individually or in aggregate could reasonably be expected to influence the economic decisions of users on the basis of financial statements. Oh, it's a huge definition. Okay. For example, let's say I'm running a business. I made a monthly sales of $10,000. All right, pretty good. But then I found an anomaly in my accounts of $1,000. All right. So do you think I would mind with this particular amount? If it's gone? Tell me yes or no. Now don't tell me that you would even mind if there's a $5 anomaly, but be particular about this $1,000. Would I mind?
Yes.
Yeah. Any particular reason mathematically, if you can spot out?
That's a complete 10%.
Yeah, definitely. It forms 10% of my revenue. Okay. So similarly, if there's this particular anomaly, it's definitely gonna influence my decision. Yes or no? See, individually or an aggregate, two could reasonably be expected to influence the economic decision. So, if there are this kind of scenarios happening, these are called material. Okay. So, similarly, auditor also sets a benchmarks. Usually, it is 1 to 2% of revenue. Okay. 10% of profit. Yeah. So, these are called material of users taken on the basis of financial statements. Now, let's say if it's $5 anomaly, I won't mind. Okay. Now, ideally, I should be minding those money, but still, $5, I won't be putting in that much of energy. Okay, fine. It's a $5 anomaly. We have to make more sales and we cannot, just stick around that particular small amount. So, yeah, materiality is that kind of thing. The misstatement, including omissions. Okay. you omit anything, are considered to be material if they individually. So $1,000 individually is gonna get my attention. That's why it's material. Okay, it's a material amount individually, and the amount is also nature-wise. Materiality is also nature-wise and amount-wise. What is nature-wise? See, from company's standpoint, the bonus amount might not be that much. The bonus amount of directors, all right? The bonus amount of managers. But it is nature-wise material. If it shifts, it's going to impact the company. So that's why nature-wise material. In this particular scenario, this $1,000, okay, it's material by amount because it is forming 10% of my revenue. Or aggregate, what does it mean? See, $5 normally it's fine. But let's say I'm having $100. Okay, it might not be individually material, but I'm having same $100 mistake 100 up to 9 times. So let's say it makes up 900%. I've set my materiality to $850. Okay, there's one more concept of performance materiality. It's set below materiality. So let's say I've made it to 700. Now, if you can look at it, aggregately they are making 900, but individually they are not. So in aggregate, they are material. Got it? So individually or in aggregate could reasonably be expected to influence the economic decisions of users taken on the basis of financial statements. So that is what material refers to. Now, what is misstatement? Material misstatement. Now, if you look at misstatement, it is nothing but the difference between required amount, classification, presentation, disclosure, and what is reported. Reported by whom? Who makes the financial statement?
Management.
Yeah, reported by management. Okay. Amount, classification, presentation, disclosure, same thing. Now, for example, what is required by? This is IFRS. The difference between the required amount, classification, presentation, disclosure as per the appropriate financial reporting framework. In our case, it is IFRS and IAS. For example, can someone recall me what's the criteria for IS2? Tell
Lower
me.
of cost or NRV.
Yeah, great. Now, okay. Now, IS2 requires the measurement of inventory at the lower of cost or NRV. Okay. So can I say this? I mean, basically, this is the amount, classification, presentation, and disclosure required by the appropriate financial reporting framework. Tell me yes or no. So I have to present it at the lower of cost or NRV. That is what appropriate financial reporting framework states. Now, what management did was they did not follow this and they just listed the inventory at cost. Now, what is happening? Inventory is going to be overstated. Yes or no? If they did not follow this?
Yes.
Yes.
Yeah. So can I say there's a difference between what was required and what was actually reported?
Yes.
Yeah. So this is what a misstatement is labeled. Now, when you combine misstatement with materiality, let's say the change in the value was such huge. In this case, let's just keep it at 1000 because we have, considered $1,000 to be material in this particular scenario. Now, if there was 1000 is a material amount and it was a misstatement as well, then it is labeled as material misstatement. And as an auditor, what's the core purpose? To reasonably assure that financial statements are, as a whole, are free from material misstatements. That's the whole sole purpose of auditing. Got it till now?
Yes,
सर
sir.
एक बार फिर से बोलो ना मटेरियल मिसस्टेटमेंट.
See, what is misstatement? You got about misstatement? What exactly is a misstatement? The
टेन
difference
थाउजेंड
between
का प्रॉफिट 1000 से कम 1000 बताए वो.
acha the misstatement. So let's say I'm making a revenue of $10,000 per month, and I found a omission, or let's say normally a mistake of $1,000. So as I discussed, it is basically forming 10% of my revenue. Okay. So yeah, definitely this particular 1,000 is gonna influence my economic decision. So based on numerical value, it is material. So are we clear with material?
Yes, sir.
Yeah. And now misstatement is what? Basically the difference between amount, classification, disclosure, what was required by IFRS. In this case, we discussed about IS2, cost and NRV. Now you remember, if I did not disclose the inventory at NRV and kept it at cost, won't it be overstated? Won't the profits be boosted because the closing inventory value would be high?
Yes, sir.
Yeah. So when there's a material misstatement, in this case, let's say the inventory value was overstated by $1,000 and we considered 1,000 as our material amount. So if there's an 1,000 mistake and it's a misstatement as well, 1,000 amount is material and it's a misstatement, then it's called material misstatement. And what's the purpose of audit? To provide a reasonable assurance and then provide an opinion on whether financial statements are free from material misstatements. Got it?
Okay, sir.
Yeah. And then report on financial statements, communicate as required by ISAs in accordance with the auditor's finding. Now let's just give a look. Let's just get a look and what's the exact, procedures, what's planning, and then what's our assertions, what are the procedures for audit. So till now, are we clear what exactly is the definition of audit? What is materiality? What is misstatement? What is appropriate financial reporting framework? The three-party relationship between the intended users, between the shareholders, the intended user, basically the shareholders, the management, those statutory governance, and the practitioner. External practitioner here is the auditor. He gives an opinion over what? The subject matter. Subject matter is prepared by who? The management, as per appropriate financial reporting framework. So are we clear till now?
Yes, sir.
Yeah. See, there are series of ISAs that a auditor needs to follow. Okay. International Standards on Auditing. So that's going to be 200, IAS 300. Okay. Then ISA 400, ISA 400, so on and forth. 500 and 700. Basically, they are for reporting. Okay. This would start with responsibilities of auditor. All right. Like similarly here, as you can see, the entire audit process looks like this. First, there is engagement, not the engagement word that you are used to till now, but there's an audit engagement happening before any audit commences. What is an engagement? An engagement letter is issued, sorry. Okay. It has all the terms of audit. Let's say responsibilities of audit, limitations, although everything is listed in that engagement. And then comes planning. Okay, ISA 300 covers that you need to plan your audit, and definitely it's a hectic work to do, so require a lot of planning. So let's say you are an auditor, you got an engagement letter for a company. Okay, so what do you think you're gonna incorporate while planning? Don't you think you're gonna assess some risk? What are the risks associated with that particular company? So let me just give you a layman example. Okay, let's just believe there are two companies. Okay, one is a startup. Okay, recently listed. Okay, let's just make it recently listed. and one is an established company. Okay, so according to you, which company might, okay, I'm just saying, might contain more of material misstatements just by looking? Tell me.
Established company.
Established.
Okay. Everyone agrees with established company?
Yes, sir.
Why so? Can you tell me? Because of the amount of transactions?
Yes, sir.
Sir, more incentive.
Huh? But don't you think they they are an established company, a lot of audit reports have already been issued. They have particular rapport to maintain and they know the industry well. So don't you think they might have tackled all the problems? And then internal controls. I'm not explaining internal controls right now, but internal controls, how the process of information flows, all that would be stronger in this particular established company. So the risk of material misstatement would be less. I'm just analyzing it. I'm not definitely saying this, it would be more or less. Tell me, yes or no?
Yes.
Yes,
Sir.
sir.
Now you getting my point. I'm not saying about incentive. You do not have to think like that. That okay, this is a company, there are a lot of transaction involved, a lot of incentive to but just look at it, it's an established company, they have a stronger board, they have strong internal controls. We'll discuss deep about internal controls. Okay, so they have seen previously also, they have experienced a lot of frauds happening. So till now, if I'm getting an audit, so I know that the risk of material misstatement would be less. Now let's say a startup which is recently listed, okay, they might also be having strong internal controls. I'm not denying it. Controls. But they also have some cryptocurrency in their assets. Okay. They also do not have robust internal controls. We'll talk about what are internal controls. There is less staff involved. Okay, though they are listed. But don't you think this cryptocurrency thing, this inherently increases my risk? How am I going to value this particular thing? It's not regulated enough. But still, they have listed it as an asset. Internal controls are comparatively weak. So, don't you think in this case the risk of material misstatement would be higher?
Yes.
So, yeah, this is what is planning phase look like. You get the engagement, you make a plan. Okay, so this is the industry that I'm going to work with. And okay, if I look at it, there are chances that this is particularly inherently risky to this particular industry. I have to, calculate this. And then particularly audit is planned. And then procedures are followed, risk assessment procedures. I have ROMM, risk of material misstatement. We just now discussed what is risk of material misstatement. The susceptibility of, what are the chances that you're going to find material misstatement in this particular financial statements of the company. Okay, so how are you going to do this? You are going to follow RAP, risk assessment procedures, like inquiry. Okay, some analytical procedures. What are analytical procedures? So let's say previous year the profit was $20 million. This year it significantly fell to $12 million. There might be genuine reasons also, but by the look of it, can you just infer that some things might be wrong? Yeah.
Yes, sir.
Yeah. So these are called analytical procedures. And then after doing all this, I'm getting the kind of risk of material misstatement. Okay. So under that also there is control risk, and this is particularly audit risk. Sorry, audit risk. Okay, control risk and detection risk. Now, under control risk, there is some inherent risk and there is internal control risk. Okay, basically control risk only. But what are inherent risk? I can say three type of risk: control risk, inherent risk, and detection risk. What is inherent risk? I cannot do anything about it even by implementing internal controls in place. For example, nature of business. Okay, let's say a lot of cash is involved. Now you know that cash is difficult to trace. So don't you think that particular business would be inherently risky? That's out of my control.
Yes.
Yeah. Now what are internal controls? The systems in place for the reliability and integrity of financial statements. Okay. Okay. So this are internal controls. So I'll give you an example of internal controls. There's a maker checker concept. Let's say one raises a demand for expenditure. Okay, that this particular thing is required for the office, and one approves it. Okay, so there are two people involved. Okay, now let's just say the one who requires that particular amount, let's say expenditure, he only approves it. So what's gonna happen in this case? Tell me. If I'm the one raising the request, okay, I am the one who requires, okay, this particular, say I company allows me some expenditure, and I'm the one who, demands for reimbursement, and I'm the one who approves it. It's gonna happen like this, but just say, for example, what's gonna happen in this case? Tell me, don't you think there's an increased risk? Increased risk of fraud? Hmm? And if there is other person, okay, who's there for approving my expenditures, so definitely there's gonna be a maker checker concept, and yeah, he's not gonna approve, falsified expenditures. So this is called internal control. See, it's maintaining the integrity of financial statements. So there is an internal control risk. So company has internal controls in place, and if they are not working, okay, so that's called control risk. And how do we check control risk? By using compliance procedures. Okay, let's say there's a system in place. Okay, this particular transaction comes in. Okay, it is getting verified through the software, and then ahead there are four levels of approvals required, so on and so forth. So what's the auditor is gonna do? It's gonna put a dummy account and check whether the control is working or not through compliance procedure. Now, tell me, if the company is having strong internal controls, what can I say about that company? If by assessing, by doing some compliance procedures, If it's having strong internal controls, what can I say for that company?
The risk for material misstatements will be less.
Yeah, good. Roman would be less. So don't you think editor will have to do editor will have a lot less headache when it comes to further audit procedures? Tell me yes or no.
Yes, sir.
Yes.
Yeah. So we've discussed one is inherent risk, one is control risk, and then comes detection risk. This is controlled by the auditor. How it is controlled by the auditor? Basically, uh, detection risk is what an auditor did not design the procedure appropriately, or let's say within detection risk also there's one sampling risk and detection risk he didn't properly apply the procedure and gather appropriate evidence which he could have, basically mistake from his end. And there is sampling risk. Now as discussed, the auditor cannot review everything, check everything. So basically what the auditor is going to do, he's going to take out samples, okay, revenue samples based on the materiality from different, okay, this particular timeline. I'll take some examples from Jan, Feb, June. So it might happen that the sample that he did not collected or used for reviewing had material misstatement. You getting my point? So that's called sampling risk. And what is detection risk? That he could have gathered the evidence. How auditor gathers evidence? By following a procedure. Procedures are followed by the auditor. Let's say they want to check the assertion of existence. Then he'll review the documents and the documents would be acting as evidence. Let's say auditor did not, follow that. So that's detection risk from auditor's end. So what the auditor can control, tell me. Can he control the inherent risk? Tell me.
No.
Can he control the control risk? Because it's implemented by the management. Remember, internal controls are the responsibility of management. They are not the responsibility of external auditor. External auditor comes at play. He looks at the company, he looks at the internal controls, then he does compliance procedures, and then based on his, these are all risk assessment procedures. Based on his risk assessment procedures, he'll conclude whether the internal controls are strong and the internal controls are weak. So if the internal controls are strong, and control risk is low, inherent risk is also low. So he has a bit of buffer to, get relaxed in terms of detection risk. But let's say there's a company where control risk is high, inherent risk is also high. So he has to manage with the detection risk. He has to be very cautious with all the procedures and he has to do test of details. Getting my point? So detection risk in that case needs to be maintained. Got it?
Yes, sir.
Okay. So these were procedures. Test of control is compliance procedure. And then after test of controls, first definitely they're going to do test of controls and based on then he'll assess, okay, the company has higher risk or lower risk. And then there is substantive procedures. Okay. At assertion level. Before discussing substantive procedure, we will talk about assertion. Assertion is once again representations by the management. What does that mean? Now, if we look at financial statement, the P&L items, can I say them as transaction and the account balances? Balance sheet is what? Balances as at. Okay. So account balances and transaction. So I have to check the assertion based on this criteria. Occurrence, completeness, accuracy, cutoff, classification, presentation. I'll briefly talk you through this. For example, occurrence. Did this particular transaction pertain to the entity? For example, a sales happened of $500. Okay. So this assertion of transaction is what? Here, in this case, it's sale. Sale is a transaction, and transaction is an assertion. Assertions are basically representations by the government, management. Okay. So what does that mean? Because management is says a $500 sale occurred to the entity. Agree? Till now, are we on the same page regarding transaction and occurrence?
Yes, sir.
So let's say $500 sale occurred. Now the auditor has to review these assertions. Auditor has to check this assertion of this transaction. In this case, it's a sale. So here the management is saying $500 sales occurred. So what the auditor can do to gather some evidence regarding this sale? What is he checking? Occurrence. Did this particular sale pertains to the entity? So what's the procedure he is going to design to? Procedures are for what? For evidence gathering. So could you suggest me some procedure based on this? I want to, check the occurrence of this particular sale happening to the entity. Management is saying $500 worth of sale happened to the entity. Now, as an auditor, what would I do so that I gather evidence?
Check sales voucher.
Yeah, pretty basic. A procedure. Yeah. Review sales voucher and agree with the sales data. Can I say this? Hmm? Now, if you look
Yes,
at the
sir.
first word review, these are basically the activities performed by the auditor during the procedure. So it could be review, it could be recalculation, it could be confirm. Okay. So in this case, I'm reviewing the sales voucher and agree with the sales data. So from that, what I'm going to get? Sales voucher. Can I say that this is an evidence for the conformity of occurrence?
Yes.
Yeah, so this is how I obtain evidence and auditor obtains evidence. For this case, it was a transaction. Let's just look at account balance. Account balance is balance sheet item. Property, plant and equipment. IAS 16.
Yes, sir.
Yeah. Now, as per IAS 16, the management has listed that this is the building that I'm having and it is valued at $10 million. Okay, fine. In the balance sheet, the value shows as 10 million. Now I want to check the assertion of existence whether this particular building actually exists or not. So what's the auditor is gonna do? How am I going to perform a procedure based on checking the existence of this building? Simple. Physically inspect the site for buildings confirming the existence. Can I say that this is a valid procedure?
Yes.
No. Now I cannot say I am just a witness. I cannot say, okay, I've seen the building. Now tell me one procedure for gathering evidence. Let's say, yeah, rights and obligation. Rights and obligation, which means basically I'm having the ownership, right, of the building. So for that, which procedure I can do to gather some evidence? Can I say review title deeds and property document to confirm rights and obligation? Yes or no? So through this, I'm getting the property deeds, title deeds and property document as an evidence. From those evidence, I can form conclusions. And from those conclusions, I can form audit opinion. Agree with me or not?
Yes.
Yes.
Let's just check one more example for the same building. Now, there is depreciation. Okay. Based on that, after deducting the accumulated depreciation, I'm balancing, showing the net balance of that particular building in my balance sheet. Now, what procedure can I design? So can I say recalculate the depreciation on building, depreciation on property, plant and equipment to confirm arithmetical accuracy, confirm the amount. Yes or no?
Yes.
So these are how procedures are designed, and from these procedures the auditor gets an evidence. Now the thing with evidence is it should be sufficient and appropriate. Okay. What is sufficient and appropriate? Simply not too less, not too much. Basically, able to form conclusions. Okay. Got it? So yeah, these are the assertions for transaction and account balance, existence, rise and balance, completeness, whether the amount is complete, valuation. For example, as per IAS 2, simple. IS2 requires the inventory to be measured at lower of NRV or cost. This is required with the appropriate financial reporting framework, and that helps in the valuation. The inventory should be valued at NRV. Okay. Now let's say the auditor sees that inventory is not valued at NRV. Okay. If he finds that it's the appropriate financial reporting framework is not followed, now he is gonna design a procedure, list it as a misstatement, and then he gather evidence. Okay, the inventory value should have been this and communicate it to the management. And if the management does not follow and if it's material, then it passes through the opinion. Got it? So are we clear till now? This will have detailed session on this. This was just an overview. Okay, how the audit process looks like.
Sir, completeness means
Completeness, whether the entire amount and complete amount is listed. Now let's say sales happened. Okay, sales happened at some of the sales generated cash. Now, as per the data, it's showing me the cash balance is this much, but in reality, it is not. So the auditor has to confirm that this particular account balance, like account balance, is complete or not. Okay, if the company is saying we are having $40,000 as cash balance, the auditor needs to confirm that. Okay, so simple audit evidence is going to be the bank statement. All right. So yeah, these were the financial statement assertion, test of detail, going into the account and then checking that particular account if the auditor is skeptical about that, and substantive analytical procedures. One of the analytical procedures we performed at risk assessment procedures. At the final stage of audit as well, we do substantive analytical procedures to check whether there are any inconsistencies or not within monthly sales. Okay, so in particular this month, November, monthly sales jumped. Now the auditor will think, okay, the management will say it was because of the demand, but the auditor needs to be skeptical about that. Okay. Now, fourth one is evidence, assertions in financial statements. Evidence is gathered from, performing procedures. Then finally conclusion, and then the auditor issues an opinion. Opinion is also not that straightforward. And after auditor will get an opinion and then finally report it as per ISA 700 series. Okay. Now, when it comes to opinion, there are different types of opinion that an auditor can issue. One is clean, unmodified opinion that, okay, there are no material misstatement in the financial statements and they present true and fair way. Okay. And then comes the modified opinion. First is financial statements are materially misstatement. That's a fact. But it also depends whether that material misstatement is pervasive or not pervasive. What exactly is pervasive? Is it throughout the financial statements? If you look at the word pervasive, is it everywhere in the financial statements? You can say God is pervasive. You're getting my point. So if there is material misstatement, financial statements are materially misstated, but the materiality is not pervasive. It just, it is isolated. It is a material misstatement. In that case, we discussed that $1,000 is a material misstatement. But except for that particular item, we can say the financial statements are free from material misstatement. So I'll just accept for and then issue a qualified opinion. Now, what if the material misstatement is pervasive? The matter was fundamental for financial statement. The sales procedure was wrong, for example, was completely wrong. Okay, it boosted the profit, and let's say for example the management booked a sale for which they haven't provided the performance obligation. So don't you think it is going to be pervasive because it's going to affect my balance sheet? It's going to affect a lot of other factors as well. Okay, so that particular matter is pervasive. The matter was fundamental for financial statements, so in that case the auditor is going to issue an adverse opinion. Got it? So are we clear with that? One is clean opinion, nothing free from material misstatement. One is modified opinion. In that also, we have to see if the matter is pervasive or if the matter is not pervasive. If the matter is pervasive, then adverse of opinion. And if it's not pervasive, then except for matter stated in the paragraph, the material misstatements are free from material misstatement. You just have to highlight that particular thing that is materially misstatement. Now, what if the auditor is not able to, get sufficient appropriate audit evidence? In that case, the auditor is gonna issue a disclaimer of opinion. Got it? So this is audit opinion, and this is finally, gets audit opinion gets into the final audit report. So that's how, the internet users, they can see, okay, whether the financial statements are free from material misstatements or not. So this is the entire process of audit, and these are divided into parts. That there is internal control. Okay, so in that we'll learn about what exactly is internal control. Should the work of internal auditors be, relied upon? How do we gather evidence? What are the types of evidence that we have? So on and so forth. So this was the particular introduction, so that you just get an idea of what exactly is audit. How do we deal with audit? How do we design the procedures? Okay. So we'll begin the session. See, in the first lecture, what have we discussed? We discussed the flow of audit. What goes like first, the auditor has an engagement. Then we go on to planning. Under planning, we have risk assessment procedures and further audit procedures. We'll discuss that in the coming classes, what exactly are the risk assessment procedures. But to be specific, that is IASA 315. What IASA is? They tell the auditor how this particular thing needs to be done in layman terms. Okay, so IASA 315 is risk assessment procedures, and IASA 330 is further audit procedures. Okay, then we have system controls and internal audit. We'll talk about that in IASA 315, basically how an auditor assesses the internal control. We also briefly mentioned audit risk. What comprises of audit risk? Inherent risk, control risk, and detection risk. Here, these two cannot be managed by the auditor. Okay, because these are like client side. These are on the client side. Inherently, the business is inherently risky. If let's say the business involves a lot of cash transactions, so that particular thing is inherently risky. Control risk is basically the client system has internal controls. Like this particular fraud or this particular transaction should happen in such a way. So if client has weak internal controls, like there is lack of segregation of duties and so on. So if the client has weak internal controls, so that means that control risk is high. So if both inherent risk and control risk both are high, so detection risk by the auditor's side needs to be set low. Now auditor needs to perform more procedures to manage that, had to collect more samples, so on and so forth. Under detection risk, we also have sampling risk and non-sampling risk. We'll discuss that forward. Then after that only, the auditor gets evidence. From evidence, the auditor forms conclusions. From conclusions, an opinion is formed, modified and modified. Yeah, coming on to that. And then finally, it is reported. Then you get audited financial statements along with the auditor's report. So this is the exact entire flow of audit. Now, how are we going to incorporate that into double A syllabus? You might think it's a 70 marks theory. Okay, right, just hop on to risk and auditors respond to risks and internal controls. But that's not how it's done. It's better that you first gain an understanding. Think like an auditor. Think like an auditor, then only you can get a business context and business awareness. Okay, so first we'll start with engagement. And remember, before we begin on how an audit is conducted as per ISAs, International Standards on Auditing. What are the ISAs? ISAs are formed by IAASB, that is International Auditing and Assurance Standard Boards. They issues ISAs and ISQMs. ISQMs are the new ones, International Standards on Quality Management. Okay, they sit beside ISA 220. We'll discuss about that. Because audit is not just about that you have done the audit, you also have to maintain the quality of an audit, so that credibility of the profession is also maintained. And then we have IESB, that is International Standards on Ethics Board for Accountants. Ethics is basically how your mindset should be as an auditor. See, in the first class also, we discussed about stewardship, and there is conflict of interest. Okay, these two things are there, right? In between the auditor and, in between the management, who are the responsible parties, and the shareholders, basically the intended users. Now, to bridge this gap, we hire a practitioner, that is our auditor, the hero. Okay, now auditors is going to give reasonable assurance on whether the financial statements are free from material misstatements or not. Okay, the auditor gives reasonable assurance. Now, the question arises, first of all, why should we trust this guy? You might argue because he's an ACCA or a CA. Okay, yeah, that forms one part because that proves his competency. That is also a statutory requirement for India. That in India, in order to audit public companies, you must be a member of ICAI, that is Chartered Accountant. Okay, and if talking about ACCAs, you can get a membership ICAEW. You can get there is memorandum of association, and when you demonstrate audit experience in that country, like in UK, you can also audit public companies. Okay, so that's for ACCA, but you need to be a member of ICAEW. Okay, ACCA basically bridges that gap and it makes the path easier for you. Okay, so this is what many people argue because there are ACCAs and CAs, but it's not just about that. ACCA has code of ethics. Okay, that an auditor needs to keep in while conducting an audit. So ISAs tells the auditor what exactly to do, and then code of ethics has basically the framework on what should be the mindset of the auditor. Coming on to that, like ISAs are international standards on auditing, they drive the work of the auditor. Now the code of ethics protects the mindset of the auditor. We'll discuss that there is integrity, there is objectivity, there is professional behavior, confidentiality, and so on. We have 5 code of ethics. Okay, and ISQM, that is how the firm ensures the work is consistently strong. We have ISQM 1 and 2. Okay, that's a different thing. But yeah, these 3 are basically the backbone when it comes to audit and assurance. ISAs, code of ethics, and ISQM. Now, do they ask directly what exactly is ISA 240? But no, they don't ask it. That you have to ratify everything right from the series. It's not like that. But still, as an auditor, as a student of a professional community, you must be knowing what exactly is ISA 200. You might stumble with ISA 200, ISA 210 and do not pinpoint the exact definition of it. But yeah, you should have the soul of it. Like ISA 200 is overall objectives of the auditor. Now you should just try to use that overall objectives of the auditor, obtain reasonable assurance. Okay, agreeing to the terms of audit. Yeah, I need to verify whether preconditions of an audit are present or not. Got it? So
Yes,
see,
sir.
throughout this revision series, we are going to have one client. One client, basically Horizon Appliances Limited. We are an external audit firm. We are taking on to the engagement of Horizon Appliances Limited. So we have entity profile, governance, pressure points, operational red flags throughout a different audit, because right now we are going to deal with governance, ethics, and acceptance. Why audit exists? We discussed that in the previous class. Okay, what exactly is audit? Why there is a need for audit? So on and so forth. So now we are going to discuss with this, then planning, systems, evidence, and final review then. Right now we are at this stage. So this is our client, and this is going to stay the same throughout the stages of audit, so that you can coherently link that with whatever you have learned for the subject. All right. So client is Horizon Appliances Limited. Entity profile. Let's just look at the entity profile. Get on our auditor lenses. Mid-size listed manufacturer. Okay, listed manufacturer. No CLAR. Risk of non-compliance. Okay, and high risk of material misstatement, control risk, and all that we have to think about. And distribution of kitchen appliances. Okay, distributor of kitchen appliances. Inventory. Yeah, just as an auditor, you can think of some rough points, right? It's not a
Yes,
service
sir.
organization, it's manufacturing organization. Operationals includes 2 warehouses. Yeah, okay, 2 warehouses, easy for inventory count. And a growing online channel. Yeah, new ERP, possibility of new ERP system. I might have to dig into it. Yeah, recently completed an ERP implementation. Like governance, I'll discuss what exactly is governance. Management bonuses are strictly tied to EBITDA, like interest before interest, tax, depreciation, amortization, EBITDA, and profit before tax, PBT. Bank convenience are currently linked to gearing and interest cover. So don't you think there's a conflict? Just by looking at the statements, bonuses are linked to interest before interest tax. Now, don't you think the management is incentivized to boost profits, to boost revenue, to increase EBITDA? Yes or
Yes,
no?
sir.
Yeah. And bank convenience. See, bank are also our intended users. Okay. Convenience are basically this points should be there. When we are lending you, these are the particular convenience. And as per the convenience, your gearing should not increase to this level. Your interest cover ratio should be this much. Otherwise, there's a breach of convenience and you have to face the repercussions as a business. So yeah, operational red flags, what the auditor identified, rising warranty claims. Oh, provisions. On a newly launched product line, the company utilizes an outsourced internal audit project. ISA 600. Yeah. Auditors management expert, ISA 610. Okay. Whoever is watching this revision, you might have gotten an idea. ISA 610 using the work of internal audit, management expert, and ISA 620 is auditor's expert. And ISA 402 was different organization, right? T1 and T2 report.
Yes,
So
sir.
got clear? Yeah. Horizon Appliances, we are dealing with this company as an auditor. Okay. So see, the credibility gap, just a recap. The distance users are the shareholders and the bank. We can label them as intended users of the financial statement. Okay. Now, as it's a listed company, company law, legal boundaries and mandates, professional regulation, industry-wide oversight needs to be done. ISS, consistent approach, planning, evidence reporting, and quality management, firm level direction, review and monitoring. And management are the responsible parties. Now, it was established right from the start that management is responsible to prepare the financial statements. Here are financial statements are basically subject matter, and the auditor provides an opinion over the subject matter against a set criteria. Our set criteria is appropriate financial reporting framework. And as we are students of ACCA, what is the appropriate financial reporting framework?
IFRS.
IFRS and IAS. IFRS are the new rules. Slowly, every IAS is going to be IFRS. Okay. So basically, and if we talk about to do all this, what the auditor needs, obviously, rights, access to evidence. If the client is not providing rights to the account balances and all that, so there's a scope limitation. We'll discuss that further in reporting. But yeah, must have access to books, records, and explanations. An auditor who cannot obtain evidence cannot form a strong opinion. Okay, delays in inventory records damage the audit. And now, duties is proper performance, must perform work in accordance with ISAs. Okay, and if not performed ISAs, that negligence from the side of auditor, ethics, and applicable law. Okay, now beginning like this, we are dealing with. See, if you can see, first is engagement. We are dealing with engagement. I once again repeat, you are not supposed to ratify all the ISAs with numbers and all. But if you can see, as per the series goes like this: has 200, planning as ISA 300. Basically, planning is ISA 300 only. Okay, and then the system control and internal audit using the work of is 610. And when it comes to internal audit, we have work or using the work of service organization internal audit 600 series, and evidence is ISA 400 series. Don't go for that, but yeah, we have particular series for that. And then okay. Just a sec. Yeah. Opinion is basically ISA 700 series. Okay. So this is how the audit flows goes like. So if I am concerned with ISA 200, we have overall objectives of the independent auditor, basically to obtain reasonable assurance. Why reasonable, not absolute? Because of the inherent limitations of audit. Got it?
Yes, sir.
And agreeing to the terms of audit, whether preconditions are present or not. Like management accepts it's responsible for the preparation of financial statements, whether the management is agreeing on giving the rights to whatever is required for the audit. ISA 200, quality management for an audit of financial statements. Quality management is basically the work that you're doing. You need to review your work done. Basically, if I'm an audit junior, my work would be reviewed by my superior. And finally, all the major transactions, major material balances would be reviewed by the engagement partner or the audit manager. This is basically the review cycle, confirming and having a consistent quality. Okay, that also aids to the credibility of profession. All right, ISA 230, audit documentation. What if someone challenges you, at the court? As an auditor, you need to show the proof that what you have worked through, how you have collected the sample, so on and so forth. That is covered under ISA 230. Audit documentation must be sufficient to enable an experienced thing here to notice when you are preparing. As an auditor, when you are preparing the documentation, an experienced auditor should be able to express and verify the work done on what actually was done. Okay, then only you can say that okay, I have sufficient audit documentation prepared from my end. Okay, so if someone challenges you in the court, this should be done. All right,
Yes, sir.
perfect. And then we have ISA 240, although it should more aligns with the planning stage, but yeah, auditor's responsibility relating to fraud and error in an audit of financial statement. ISA 240 states that the auditor need to be skeptical. Skeptical, although, is also listed in ISA 200 that you need to be skeptical throughout the audit. Do not take things at face value because management has incentive. Okay, there could be collusion between employees, there could be fraud concealments, on and so forth. So auditor can be like, yeah, buddy, I trust you. This should not be the case. Okay. ISA 250 is consideration of laws and regulation. Definitely public entity, whether there is a non-compliance. If there's a non-compliance, there's a reputation damage. Obviously, a material area. Auditor has to find that, okay, whether there is a no-clar. No-clar is Non-compliance. Non-compliance with laws and regulation. Okay, the auditor needs to perform procedures over that. Okay, and if not so, he needs to gain an understanding with the laws of the company and so on, whether there is any situation where there is a non-compliance. Okay, because definitely as an intended user, you also wish to know, okay, what's happening. Is the company obeying the laws or not? Because you cannot piss the government off, right? Then is ISA 260. Communication with those charged with governance. We'll cover that later when we'll talk about internal control deficiencies. Is those charged with governance is the significant matter that the auditor in his professional judgment, okay, believes that needs to be communicated is covered under ISA 260. And ISA 265, major one, where you can be asked a 30 or 20 marker question. Okay, remember control deficiency and control recommendation. That's covered under ISA 265. Communicating deficiencies in internal control to those charged with governance and management. Okay, management. We are not supposed to, redesign the system. But if something is wrong, as an auditor, we are responsible to communicate any deficiencies and the recommendation to the government, management. All right, so that's under ISA 265. Clear with this?
Yes, sir.
Okay, now comes the governance split. Before we move on, governance is basically, corporate governance is basically how a company is governed and managed. Basically, the principle surrounding those. Okay, so if I talk about a company, you can imagine there are board of directors, okay, and then there is management, right? So those charged with governance, you can tell them as board of directors. And management and directors are involved in the day-to-day operations of the company. So they know the business better, right? So these two basically are responsible parties. Answerable to the shareholders, but shareholders don't trust them. That's where our hero external auditors comes into picture. Is independent evaluator. So the management and director is prepare financial statements. Responsibility of responsible party. Prepare financial statements, select accounting policies, maintain internal controls, assess going concern. All these are the responsible and provide full information to the auditor. Okay. Now TCWG is overseeing reporting quality, monitor internal controls, manage enterprise risk, manage the relationship with external auditor. This is where audit committee comes into play. See, if you know that whenever you talk about board of directors, think of it as committee. We have a remuneration committee, basically who sets the remuneration for all the board members. Okay, so CEO is gonna get paid this much, and the chair, the non-executive directors, they're gonna get a flat fee. So if I talk about a normal corporate governance code, okay, what shall be done? So we have executive directors who are directly linked with the company and non-executive NEDs. So ideally, there should be at least 50% NEDs and more than that. Who are NEDs? NEDs are basically non-executive directors who get a flat fee for having a chair at the board. So definitely they are going to be more objective, more independent than the executive director. Yes or no?
Yes, sir.
So those are NEDs. Okay, now NEDs like audit committee should be made up of entirely NEDs, non-executive directors. Makes sense because our audit committee is responsible for the integrity of financial statements and appointment or removal. Appointment is approval always lies with the shareholders. Don't get confused with that. See, external auditor, the entire need for an external auditor has been raised by the shareholders only. But okay, we don't trust the management, we want this. But yeah, ideally what happens is the audit committee recommends to shareholders that okay, we can go ahead with all these firms, and then finally when the shareholders approve, then the audit committee appoints. Got it? Clear with this?
Yes, sir.
Perfect. And then our hero external auditor, his role is to obtain reasonable assurance, gather audit evidence, evaluate material misstatement, and issue an independent report. Do not take over management duties. Nothing. Well, this will get interesting when we'll talk about threats. Threats to the ethical code. Okay, classic ACCA AA confusion area. Yeah. So that is do not take over management duties because that's self-interest, self-review. Threat is so huge, you cannot overcome that. You cannot mitigate that. Okay, now comes the governance shape. As management, we have Horizon Appliances Limited, Horizons Management, EBITDA bonus pressure, and optimistic accounting. The audit committee and external auditor. See, why governance matters is governance shapes the tone at the top. Okay, and the strength of the control environment. Yes, definitely. A passive board creates a weak control environment regardless of transaction level rules. Definitely that's going to happen because from the tone at the top, if you're saying we don't mind transaction level, okay, this should not be the case. So definitely the controls are going to be weak, and yeah, inherent risk high, control risk high, auditor has to do a lot of work, risk is assessed high, risk of material misstatement is going to be high. Now comes the audit committee. As discussed, the audit committee sits between the auditor and the board. It preserves independence and ensures issues like control deficiencies, reporting judgments, and audit findings are escalated properly. That's why you see when we assess whether, as per ISA 610, whether we should use the work of internal audit, that's very unique. If they are reporting directly to the audit committee, if yes, they are more independent. Why so? Because this comprises of entities. Okay, so they do not have as in such motto that okay, this is gonna happen, we should do this, because they're not concerned with company's performance and so on. They're getting the flat fee. If you talk about any executive directors whose bread and butter is dependent on the company, so yeah, they're gonna be more concerned, they're gonna be more like okay, involved, might be involved into fraud, might be involved into creative accounting. Okay, just like in this case, EBITDA bonus is there. Okay, so they have incentive to inflate the profit, so on and so forth. So that's why the shielding function, the audit committee acts as a shielding function. Now the external auditor. See, Horizons management bonuses are tied to EBITDA. So creating pressure around year-end to revenue recognition and inventory valuation, definitely. You inflate the inventory, closing inventory high, COGS is less, profits are more. A strong audit committee is required to buffer the auditor from this management pressure. Yeah, it's a requirement of the audit committee, and that overall forms a good corporate governance. If definitely, biological sense, if a company has good corporate governance basically it is following like they are having more NADs. Okay, there's an audit committee with appropriate members, appropriate non-executive competent members. So if a good corporate governance is there, so very high likely chance that the controls are going to be also strong around surrounding the financial statements. Clear till now?
Yes,
Tell
sir.
me. Perfect. Now we have this. We had been discussing what is the let's put it here. Yeah. We have been discussing why should we trust on the auditor. And we mentioned about ethics. An auditor should be ethical. So if I talk about ACCA Code of Ethics, ACCA follows IESBS, the board that I discussed, right? Here. IESBA, International Standards Ethics Board for Accountant. ACCA follows that only. And now, what does that have? An auditor or a professional accountant should follow this. Integrity. Quickly recall me. Objectivity.
Professional competence,
Professional behavior.
confidentiality,
And competency, right?
yes, sir.
Yeah, perfect. Now, before we dive on to, do not just ratify, okay, this is integrity, this is objectivity, this is professional behavior, this is confidentiality. As I said, it's not why because we place a trust, because ACCA abides that every professional accountant and every auditor should follow this code of ethics. It's more about how you conduct, like what's your mindset during the audit. Are you integrate? Are you straightforward? Are you objective? Are you not letting anything influence your decisions? Is your behavior professional throughout the audit? Is it confidential? We'll discuss what exactly are in detail, what are their definitions. But yeah, we place trust on ACCA members and CAs because they are abided by code of ethics. Okay, you cannot say a doctor. Whenever you imagine a doctor, you imagine an ethical person. Again, even lawyers, you might have, even if you have seen any series, okay, so they might be telling things like there's conflict of interest. I cannot take upon this client, right? So same goes for auditors as well. You have to be integrate, objective, professional behavior, confidential, and competent. If you are not competent enough to take on this particular client, okay, so we should not be doing that. And why so? Because ACCA says you have to follow the ethics. As per the ethics, you are not competent enough. Okay, if you are not competent enough, don't chase the revenue. Please resign, because we have to maintain the credibility. Intended users trust, place a trust on us because of this code of ethics. As an auditor, you need to know a lot of scandals happen, like the Enron one. Okay, this happened because of the collusion of auditor only. Okay, so all those does not happen in the future. There's a trust placed on the profession. That's why every auditor, every professional accountant should follow this. Okay, so digging into the details, we just see. We had integrity. Integrity is nothing but being straightforward and honest in all professional and business relationship. What is the fact? You should state your client the fact. Be straightforward. Nothing, no mirch masala, nothing. That is you being integral. Okay, during the, and then there is objectivity. Objectivity is the most important one. Objective. Whenever you see a person, he is not objective enough. Why so not objective? Because objectivities do not compromise judgment. As an auditor, you have to make a lot of professional judgments. Okay, judgment because of bias is you leaning towards someone. Okay, conflict of interest or undue influence. Undue influence is basically, okay, client is saying, oh, you're gonna remove you as an auditor, so my objectivity is impaired. Okay, so there's a threat to the fundamental principle. Link it with that way. Professional competence and due care. Maintain knowledge and skill to act diligently in line with professional standards. First of all, basic necessity. First, clear ACCA 13 papers. Then have PER, practical experience requirement. Then become a member. Then you can say that you are competent enough. And if so, you're not competent enough, you're directly violating the fundamental principle of professional competence. Okay, so if you are supposed to take on any client, you do not have the required resources or the required knowledge to conduct that particular audit. So you should not be taking on that, because that's a direct violation of fundamental principle. Got it? Then there is confidentiality. As an auditor, we have loads and loads and access to these sensitive financial accounts. Okay, as a fraud, you can do insider trading. That's illegal, by the way. But yeah, you have the access to sensitive financial data. What does that mean? As an auditor, you are not supposed to, not at all supposed to leak that until unless it is required by law. Okay, respect information acquired through professional relationships and do not misuse it. Professional behavior, yeah, comply with laws and regulations and avoid conduct that discredits the profession. Avoid conducts like you getting into a street fight. What's gonna be the headline? Big Four's auditor get into this chaotic mess and all that. So do not do anything that discredits the profession. Okay. Now comes the important category. So what's happening is, whenever an audit wants to take on to a particular engagement, they want to comply with the fundamental principles. Okay. So no matter what happens, you have to maintain this. So is it going to always be the case? No. There might be situations in real life, because real life does not work like that. So is it like if any of this principle is not met, I should be declining the engagement? No. Which you cannot earn your bread and butter. Okay. So fundamental principles are there. So if any case there is any instance that is threatening my fundamental principle, I need to assess it. What level at which it is threatening? Like, is it threatening my confidentiality? Is it threatening my objectivity? And what's the reason for that? So Here we have threats, different types of threat. They are basically hitting my fundamental principles. And what can I do to mitigate them? To reduce the threat to an acceptable level. Okay, so first I'll mitigate them, I'll try to mitigate them, or else I'll try to reduce that to an acceptable level. Okay, this much is fine, we can walk around with this. But if the threat is such huge that nothing can be done, so we cannot take on the engagement. So the threats include the self-interest threat, like financial interest in the client directly creates a self-interest threat. Fee dependence, objectivity is impaired. Fear of losing client, that's intimidation. Bonus pressure, sorry, fear of losing a client, that's self-interest, because I am concerned that I might lose the client, so that's my self-interest in that client. Bonus pressure, never ever auditors fees should be linked with company's performance. That directly creates a self-interest rate. Okay, self-review, by the word itself you can know you are reviewing yourself. So auditing work or judgments previously made by the firm or individual. So let's say we have an audit team, they were also there for internal audit. Let's say the preparation for accounts. Okay. So definitely if the same team is there for the external audit as well, they are reviewing their own work. So as humans, we have a tendency, let's say you have created something, you have created a project, there are lot less chance that you would be strict with yourself because you are reviewing your own work. Okay, so that's self-review. Then we have advocacy, basically promoting a client or employer position too strongly. Okay, and familiarity is long association or close relationship creating excessive sympathy or trust. Long association. Mind the word here, long association. So if the question mentions 6 months or so that should not be categorized as familiarity threat. Okay. Or close relation, like, yeah, obviously if I'm with that particular boss for 5 years, okay, so now I know him. So I won't be objective in my words. See, familiarity threat, it is harming my fundamental principle, no? So I have to look for ways, like I'll rotate the partner off. I can look for ways to reduce the threat to an acceptable level or completely mitigate it. Then only I can move forward with the engagement. Intimidation is pressure, threats, replacement risk, or dominant personalities impairing judgment. If the client intimidates you by saying that we are going to remove you, that's basically intimidation threat. That is compromising your objectivity. Yes, because you have now bias. You have bias. You cannot objectively work on the audit. So clear with the definitions?
Yes, sir.
Perfect. See, now we'll take some examples. Threat category is self-interest. Final dependence or fear of losing a client. In case of Horizon, what is happening? See, we have overdue fees from Horizon. Okay, or reliance on their large contract. As discussed, financial interest creates self-interest threat. Okay, so required safeguard would be settle all fees, independent review, because yeah, we identified we have self-help, so obviously we are going to review our work, or remove the fee dependence. Okay, one client should not form more than 15% of your fees. Okay, for 2 years, 2 consecutive years. If it's done so, you are overly reliant on that client. Now self-review, checking your own work, checking your own previous work. Okay, the audit firm is asked to help value Horizon's rising warranty claims. See, ideally, what should have been done? Rising warranty claims, all the valuation relating to that, all the provision valuation relating to that should have been done by the management. Okay, and we are supposed to audit that. But if they are, we have been asked to do the provision and valuation work for that. So don't you think we would impair our objectivity? So for that, what could be the possible safeguard if this is accepted? So separate teams, one for valuation, external audit team is different, and then independent review or refuse the valuation work. if the threat is so high, if the valuations, I mean the amount is material. Okay. Advocacy is basically acting as a promoter for the client. Promoter basically during a law representation. Basically, I'm standing beside the client. Okay. Promoting Horizons shares it's a listed company. So like if as an auditor, if I'm promoting Horizons shares or representing them in a bank convenient dispute, that okay, I'm in the middleman, that I am assuring that. So that's definitely intimidation. That's advocacy. And advocacy is impairing my objectivity, impairing my fundamental principles. So what's could be done for that? So avoid all advocacy rules that impair objectivity. We should not at all be doing that. Because there's an option. Like it's not like you have already done the work. If the client is asking you that please be on our side when the bank asks for convenience, you should straight away, out of the ethics, you should be saying no. Okay. Familiarity is being overly sympathetic. Familiarity, long association with the client due to long association. The audit partner has audited Horizon for a decade. Oh God, ideally there should be a rotation after 7 years. But yeah, if this is the case, he should not be the engagement partner. So required safeguard is partner staff rotation, second partner review after the some if any work is done by that particular partner. Okay. Now last is intimidation threat, being deterred from acting objectively by threats. Threats is basically if the client is asking you that we are going to remove you as an external auditor, basically the client is threatening you. Okay. Now, Horizon management hints at replacing the same thing, replacing the auditor over a tough inventory provision. So basically, they are like, and they भी say ये कर ले वरना मैं निकाल दूंगा तेको. Okay. ये कर ले मम्मी को बता दूंगा. समझ रहे हो? So yeah, that is basically intimidation. If I'm intimidating you, I'm indirectly impairing your objectivity. Now you would be like under an influence. And now your judgments won't be unbiased. They would be biased because you are in a fear. So in this case, required safeguard would be escalate to audit committee. देखो ये गलत हो रहा है. Basically, auditor being like that. Oh, ये गलत हो रहा है. TC those charges with governance, document issues, and withdraw if necessary. If things are not working, then you can withdraw from the engagements. Got it? Clear till now? Everything, every link is associated with Horizon Appliances Limited. It's a public company, and here, as an auditor, these are the practical issues that we faced: self-interest threats, self-review threats, and here are the required safeguard to either mitigate it completely or reduce it to an acceptable level. Clear till now?
Yes, sir.
Perfect. Now comes pre-engagement. ISA 210. Agreeing to the terms of audit. Basically, you are standing at the gate of the client and you are thinking, not literally, but you are thinking whether I should be going ahead with the engagement or not. It's not like if it's a client, it's a revenue driver, your firm is dependent on it. This should be not like it should follow a path. Okay, there should be three conditions of an audit should be present before accepting an engagement. Okay, so the gate one is preconditions for audit. Okay, so check, is the financial reporting framework acceptable? Are they using NDS? Are they using IFRS? These are appropriate financial reporting framework. Okay, as per the law and regulation, this could be used, this both. Okay, so are they appropriate or acceptable? Does management acknowledge its responsibility for statements, for financial statements, control and providing auditor access? As discussed, it is the whole sole responsibility of responsible party, that is management, to prepare the financial statements. Many people get confused that auditor prepares the financial statement, but it is not at all like that. Auditors gives reasonable assurance over that financial statements. Okay. Now, is the management accepting their responsibility? The auditor needs to ask that. Okay, that is basically preconditions of an audit. If absent, engagement is fundamentally unsafe. You cannot accept that. If these all are not present. After that, independence and ethics. First, if preconditions are met, then we have to check as an external audit firm, are there any factors that are, directly affecting our fundamental principle of ethics? I'm going to check that. So do any of the 5 ethical threats exist? Like self-interest, so on, intimidation, familiarity, okay, which are going to impair our objectivity. They could impair our professional competence. If they are impairing, so you have to look for safeguards. If the safeguards are not applicable, we cannot move forward. Are safeguards adequate to neutralize them? And then comes competence and resource. Most important. Does the audit firm have the time, specialized staff, and technical capability? Because as in times, if IT knowledge for Horizon's new RP system, see, link it with the same company. During the client, it might have happened like this. There's a potential client, they have approached us, so we're going to do our research for Horizon Private Limited. Okay, while doing our preliminary research, pre-production movies, we have pre-production, right? So let's say as a junior auditor, you are new to the company and I asked you to prepare a PPT on Horizons Limited. So whatever info that you have gathered, you talked about ERP, that they have recently implemented an enterprise resource management system. Okay, so if this is the case, are we competent before taking on to the engagement? Are we competent enough? Okay, so we have to ask that. So if this is the case, we are competent enough, and if not, so we can arrange the experts required for that particular work. Then only we have to accept the engagement. And finally, management integrity, most important. Like, does cooperation, honesty, and openness appear likely? So that's why we also have communication with previous auditor under IAS 10. Okay, so if I ask the management, can I communicate with the previous auditor? I just need to know what was the reason why he communicated. Was it under a normal business relation, or whatever the reason? If management outrightly declines it, then it's a very big red flag. That's a question about its integrity. Do they cooperate? If the external auditor who was there last year, if he does not respond, that's a different thing. But management needs to allow. First, we'll ask the management, can we communicate with the external auditor who had audited financial statements last year? If the management declines, then it's a big, big red flag. Okay. Then only if all of those, if we communicated with the external auditor, when we do all of those, then only we can issue the engagement letter, and then we can say that, okay, we can go forward with the external audit. Okay. So warning, removal or resignation of a predecessor auditor often signals like removal or resignation. Okay, not consensual that we are not moving forward from auditor's side. Often signals fee disputes, scope limitations, or governance concerns. If these are the case, obviously it's not inherently safe to continue with the engagement. So these are critical risk signals, not mere administration. Clear with this?
Yes, sir.
Perfect. Now comes the engagement. Engagement has proper engagement letter. Under that, the scope of auditor, the fee arrangement, loads and loads of stuff is written. Okay, because obviously that's gonna be the form, basic documentation that the management is gonna agree upon, and then yeah, you can carry on with the audit of financial statement. So the engagement letter, what is the purpose of it? Formalizes the relationship and narrows the expectation gap. What is the expectation gap? Many of us, many of the users believe that auditor is responsible to prepare the financial statement. Now in the engagement letter, it is explicitly stated that we are going to provide reasonable assurance. And who is responsible for the preparation of financial statement? The management. All right. Before the field work actually begins. So it properly formalizes everything. So if in any case the auditor is challenged or asked by the management, then he can show that we are not supposed to do this. Then contents are records the objective scope of the audit, management's responsibilities, and the auditor's responsibilities. Like, they are responsible to do what? To perform procedures to obtain reasonable assurance, and the expected form of reports. How the reports, the final audit opinion reports, okay, would be submitted. All right. And the impact of it is explicitly documents that management, not the auditor, prepares the financials and prevents fraud. See, impact is clear. What is management responsible for? They are primarily responsible for the preparation of financial statement and to detect fraud. Auditors is responsible to provide assurance on both fraud, error, material misstatement. So this document explicitly, defies that. Okay, this is what auditor is supposed to do. This is what management is supposed to do. Now comes professional clearance, just like we talked about, communication with the predecessor auditor. So purpose is communication with predecessor auditor to reveal hidden risk. Okay, भैया क्या हुआ? क्यों छोड़ा? And the process is incoming auditor asks for reasons not to accept the appointment, ethical, integrity, or practical. And red flag is if the client refuses. See, if the management straight away refuses that to permit communication with the predecessor, the engagement is compromised. Definitely is going to be compromised. Got it?
Yes, sir.
See, continuous notes, it happens that we are with same client for many years. Continuance is the ongoing version of acceptance. Like if the same clients is there, even with existing clients, if this is the case, independence, cooperation, and changing risks must be reassessed annually. So if let's say you signed off the engagement letter in this year and you're continuing with the same client next year. It's not like you have to just reissue this letter and get a sign off it. No, but still you have to reassess it whether there is a change in integrity, just like this different key. Management integrity, competent and resources. Got it? After that only you can reissue that. Okay, and make necessary changes. Got it?
Yes, sir.
Perfect. Now, moving forward, the quality management. What exactly is quality management? Is basically how the quality is conducted and final review is done. Basically, it's basically the cycle that governs our work, the quality of work that we are providing to the client. So it's like, are we incompetent, ethical breaches, are there any ethical breaches, poor supervision by the senior audit employees, lack of review, process failures from our end. Okay. See, quality management ensures the engagement has appropriate leadership, engagement partner, competent people, the entire team, ethical compliance, proper supervision and monitoring of deficiencies. It's not like you are giving material balances to a new joinee. Okay, ask them for inventory count, fine. But you are asking them for making professional judgments. You are asking them for, making their own estimates for business valuation. You can imagine. So that's very poor quality management. So the audit is only as strong as the process behind it. So that's quality management. So acceptance, then planning, evidence, reporting. The quality management applied. So first is ask competence. Because if you are competent, then only you can start with the audit and deliver quality. If you are not competent, that's no point of it. So do we have industry, IT expertise like navigating Horizons ERP transition? Then direction or supervision. Complex estimates like Horizons warranty provision, as discussed, require more senior direction than routine cash balances. Then we have review, ensuring work is evaluated before opinions are formed. Definitely that's going to happen. And then finally, remediation, correcting deficiencies identified in previous monitoring cycles. Were they identified? Like in the previous auditor, we identified this were the problem. Now in the current, quality management is a continuous process. We have to monitor whether they were rectified this year or not. So the key insight is even technically perfect audit procedures lose credibility if the overarching quality management system is weak. Definitely. This common sense. Got it till here?
Yes, sir.
Perfect. Now we'll incorporate everything for Horizon Appliances Private Limited. Okay. Now governance and integrity. High risk. Why? Because management bonuses are tied strictly to EBITDA. Okay, so auditor actions would be requires heavy reliance on audit committee to shield auditor from aggressive accounting pressure. Now, talking about the preconditions and the framework, past, simple, data management acknowledges responsibility for statements and internal controls. Yeah, we have no issues with that. And standard reporting framework is in place. They are using IFRS. Okay, so here there's no issue. Now, ethical independence status monitors data. Horizon utilizes outsourced internal audit. Okay. The auditor action, external auditor must ensure no self-review threat exists by separating reliance on internal audit work from external assurance. Okay. Outsource internal audit by our firm itself. Okay. So that's why there is self-review threat. Now, internal audit, if they assume the management responsibility, then we cannot take on the assignment because we are assuming management responsibility. Basically, we are becoming the responsible parties. Okay, so the threat is at such level that we cannot take on the engagement. But if this is the case that some internal audit work has been done, so that comes under self-review thread. How that can be tackled with? By separating reliance on internal audit work from external assurance and by using definitely. And competence and quality status flagged for resource allocation. Data. Recent ERP implementation and complex rising warranty claims. How can we manage with that? So auditor action in that case would be quality management dictates assignment of senior IT specialist and complex provision reviews to the file. Okay. So now I believe that you would be getting a cohesive picture of we have one company, we are the auditors, we are questioning ourselves that whether we should go forward with the engagement or not. And we identified, okay, governance and integrity, there's some high risk. Preconditions are definitely present. Ethical independence, yeah, we have monitored that this is the issue and this is how we're going to deal with that. And competence and quality flagged for resource allocation. That okay, ERP system, we would require IT specialist and we do have that. And the final verdict is acceptance conditionally approved, pending assignment of specialized IT staff and formalization of strict audit committee escalation protocols by the engagement letter. This is how it's going forward. Okay, so we have accepted this and moving forward we'll do planning, analytical procedures, so on and so forth in the coming days and finally give a report. Got it?
Yes, sir.
Yeah. Okay, so this was it for ISA 200 series and whether we should accept what is governance, what are the protocols the auditor needs to follow, and what are the preconditions to an audit. Okay. Yesterday we covered the part of engagement. In that we had ISA's series of 200. Okay, so ISA 200 is overall objectives of an auditor. As you know, we have times and time discussed it that overall objectives of an auditor are obtain reasonable assurance. All right. Now these are the overall objectives and how the auditor has to maintain his professional judgment. He has to be skeptical. Yes or no?
Yes, sir.
Throughout the audit, the auditor has to be skeptical. He cannot take things at face value. It's not like he has to question management's integrity all the time and believe that management is always at the flaw. But obviously, if management is saying something, he cannot take things at face value. That's being skeptical. The auditor needs to be skeptical throughout the audit. All right. Now, moving on to that, we discussed about preconditions for an audit. All right. So that was it. Preconditions for an audit. You may also, call the previous auditor if in case something has gone wrong. And after that, after all those filters only, we can proceed with the engagement. Are we competent enough? Okay. If the particular business requires some kind of specialization, some kind of valuation experts, do we have the enough resources, be it the human resources or technical capabilities? Okay. And throughout the revision course, we are going to take one company as an example, that is Horizon Appliances. Okay. Yesterday only in the slide deck, we discussed about Horizon Appliances, who is our client, what's the risk of material misstatement, that we'll discuss today. But whether are we proceeding with the engagement or not? Obviously, we are taking this example and we have to continue the revision. So yeah, we took the engagement. Now comes the planning stage. Okay. ISA 300 in itself is planning. We have planning and strategy. So audit strategy is above and audit plan sits below that. That is ISA 300. We'll talk and discuss about that. Then we have ISA 350. Don't go on the numbers, but auditor has to do risk assessment procedures. What do you get in mind when I talk about risk assessment procedures? Like, do you think of getting a walkthrough of the organization and assess the risk of material misstatement? And as you know, we discuss what exactly is audit risk. First is inherent risk. Okay, that's natural to the organization. Then that is control risk. We'll talk and discuss about control risk as well and whether the auditor needs to follow that or not. And then we have detection risk that's on the auditor's head. Okay, so auditor, can he control inherent and control risk? Tell me yes or no.
No, sir.
Definitely not. He has to adjust with the detection and further bifurcating this into sampling. Basically, audit is sample based because inherent limitations of audit. Yeah, you cannot check each and every transaction within a set time period. Okay, and then we have non-sampling risk. Okay, that auditor did not perform adequate procedures. And audit risk, if I talk about the definition, is that auditor might give an inappropriate opinion when the financial statements are misstated. Okay, so that exactly overall forms the audit risk, and that has inherent risk component, control risk component, and detection risk component. And that follows ISA 315, that is risk assessment procedures. The auditor, think of it that way. I've accepted the engagement. Now I am in the environment of the entity. So I'll get a walkthrough. Walk through the systems, walk through the procedures. I'll do some analytical procedures. Remember in the classes we discussed about analytical procedures, they are performed at 3 stages. Okay, at the planning stage, when we are doing risk assessment procedures, at the test of detail stage also, when we are doing substantive procedures, and also at the review stage. Yes or no?
Yes, sir.
And will mark each and every risk that we identify throughout the risk assessment procedures, and we have auditors response against it. That is how your 20 or 30 marker question arrives. Like we have audit risk. First we'll identify audit risk, and then we use to write auditor's response. That includes both. Okay, checking the control system, that is control risk, how much reliance I'm going to be placing on the internal control of the organization. We'll talk about what exactly is internal control, what are compliance procedures. So, just getting through superficially speaking, when a company's internal control is strong, according to auditor's professional judgment, he is going to say, okay, I can rely on the internal controls of the organization. Okay, if the internal controls are strong, I can do compliance procedures. Okay, what are internal controls? Systems and policies in place by the management and those charged with governance for the integrity of financial statements to achieve overall objectives. Okay, I know it's an overarching definition, but get to the point. Management and those charged with governance. What are they responsible for? Stewardship concept, remember? To protect the assets of the company. Okay, so for that, there are objectives of the company that they want to earn profit, they want to maintain their reputation. Okay, so in any business, small or big, you're going to have some kind of internal control. That could be authorization that prevents fraud. Okay, basically, if you divide the particular work, there's one person who collects cash, there's one person who makes the entries, and one person who deposits. Okay, and as compared to that, let's say there's only one person who's responsible for all these 3 tasks. What's going to happen? If only one person is responsible for all these three tasks, he's responsible for cash collection, then doing the entries and making the deposits. Fraud, there's high possibility of fraud. And rather, let's say if I divide this task, I can put one cashier, I can put one accountant for the entries, and I can put one guy for making the deposits. What's going to happen? There is segregation of duties. These are preventing controls. They are going to prevent fraud. And coming on to that, auditor also has a responsibility whether there are material misstatements because of fraud or not. Okay, so this is basically our planning stage. We have risk assessment procedure, that is ISA 350. Then we decide materiality at the planning stage only, and then further audit procedure. Remember the assertion, test of details, substantive procedures, all the assertions regarding account balance and transactions. Okay, and then we create procedures at year end. Okay, so overall, by everything that you have learned till now, let's say if there's a situation where control risk is high, okay, and inherent risk is also high, so detection risk should be
No.
Low, definitely low. How can the auditor manage on this detection risk? He has to manage anyhow because he cannot control these two components. So detection risk should be low by any which means, okay, for the auditor. So what does that mean? He has to increase the substantive procedures. He has to obtain more evidence. Got it? Okay, clear till now? See,
Yes, sir.
audit risk, the risk that auditors express an inappropriate opinion when the financial statements are materially misstated. We know about materiality and what is misstatement. Difference between what is required and reported. And if that is material, then it's called a material misstatement. And we as auditor have this objective only. Okay. Now audit risk overall is inherent risk. Exactly what can go wrong naturally. Okay, we'll discuss about what about this. We had Horizon Appliances. The red flags outsource internal audit provider management bonus tied directly to EBITDA. Two physical warehouses, a rapidly growing online channel, and a recently implemented ERP system. Can I label this as inherent risk? What do you say? Hmm?
Yes,
Yeah? Yes or no?
yes, sir.
Yeah. So what can naturally go wrong for this particular organization? Control risk. Will the system stop it? The systems that the manager has put in place, okay, to prevent and detect fraud. Will they stop it? If not so, the control risk is high. If they'll stop it, the control risk is low. The auditor can rely on the internal controls. And detection risk is, will the auditor still miss it even after all this? So that's why if the auditor is missing it, that is on the auditor's head. Okay, so revised with audit risk, audit, good to go?
Yes, sir.
Yeah. Now coming on to the series, I mean, of what exactly lies in this particular is ISA 240, the auditor's responsibility relating to fraud in an audit of financial statement. Fraud and error as well. Okay. Now, as you know, fraud is intentional, error is unintentional. Okay. Now, what can the auditor do? First of all, he needs to be skeptical when assessing fraud. Because if management is involved in the fraud, there are higher chances that fraud could be concealed. There could be circumvention of employees. People who have been delegated the authorization, the guy who was looking after cash, the guy who was looking after the entries, the guy who was responsible for the deposits. If these three collude, don't you think that's gonna count for a fraud? And if these three are collusion, that's called collusion of employees. So if these three, so there are high chances that auditor cannot have evidence relating because the guy who is stealing cash is gonna distribute among these three people. Okay, so less entry is gonna be made. So as an auditor, what the auditor can do? Compare the goods dispatch notes. Yes or no? Compare the invoices. And how much stock has went. And then you can, imagine that, okay, this is the internal controls, these are the people responsible. And then after thorough investigation, he can come to a conclusion that is, there's a fraud that is being happening, right? In the organization. See, the goal for this paper is to think like an auditor. What could go wrong? What will the auditor do? That is how your exam questions are also framed. Then there is ISA 300, planning and audit of financial statement. We also have audit strategy in it. Basically, audit strategy defines the scope, timing, nature, extent, and timing of the audit, depending on different clients. Okay, ISA 315, identifying and assessing the risk of material misstatement. That is basically risk assessment procedures. Are could reasonably affect the decision of intended users. That's materiality in planning and performing an audit. All right. And ISA 330 is the auditor response to the assessed risks. Further audit procedures, be it substantive testing, test of detail of all the assertions. Okay. Now coming on to Horizon Appliances. What was happening with our company? As discussed, the profile is mid-sized listed kitchen appliance manufacturer and distributor. Operations. We only have 2 physical warehouses. I can think of inventory count and all, but we'll cover that in the coming chapters. A rapidly growing online channel, inherently risky because it's rapidly growing, so system control questionable, and a recently implemented ERP system. Okay. Pressures are yesterday also. Management bonuses are tied directly to EBITDA. That is interest before interest, tax, depreciation, and amortization, and profit before tax. Now, what's gonna happen because of that? Bank convenience linked strictly to gearing and interest cover. And we'll talk in detail about materiality. What exactly is gearing? See, bank places convenience on us. If you want to borrow something from the bank will say that your liquidity ratio should be above this. Okay, the current assets and current liabilities. And also the interest cover should be at least 5 times at any given point in time. Okay, now you can imagine if the management bonus are directly tied to interest before earnings before interest, tax, depreciation, and amortization, there's obviously gonna be some goof ups happening. There's an incentive for the management to do that, right? Yes or no?
Yes, sir.
Yeah. And bank convenience. Talking about materiality is also nature wise. Okay, so let's say there has been a change of $500. Okay, but looking at comparing with a normal overall materiality benchmark, if we let's say for example set it to $10,000, so it is nothing as compared to overall materiality. But if this particular 500 it breaches a particular bank convenience, what do you say? Will it be material or not?
Yes, sir.
Yeah, it would be material by nature. All right, got it?
Yes, sir.
And the red flags is outsourced internal audit provider. Okay, that's ISA 402, use of service organization. We have to obtain T1 or T2 report. Okay, so that we'll discuss. Rising warranty claims on newly launched product lines. Okay, the auditor might consider it as significant matter that we'll discuss later on. Coming forward, the auditor's operating system, how it is going to look like the planning stage ISA 300 is anticipating like the business models, assertions, and misstatements route, not a mechanical checklist assessment. And then throughout the audit, no matter what happens, we have to make professional judgments, be it materiality, be it what management thinks of the estimation, and if in a case, auditor should also be able to make his own estimations. All right. So these are the scenarios that could be playing out. Evaluating like all the ambiguity that's happening in the company, choosing accurate benchmarks, be it materiality, assessing control reliance. Yeah, talked about that. Whether that's also a professional judgment. Okay. Controls could be strong, whether to place reliance on the internal controls or not, that depends on auditor's professional judgment. And determining if evidence is truly pervasive, that affects the opinion. And professional skepticism throughout the audit, maintaining a questioning mind, resisting easy explanation, where surrounding facts suggest risk corroborating evidence. Okay, if evidence tells a different story, management is saying a different story, then yeah, you have to question the management and not take things at face value. Got it? Now comes the understanding the entity, getting a walkthrough of the organization, that is was ISA 315 risk assessment procedures require. So risk assessment is fundamentally weak if based only on trial balance. What do we have as an auditor? As you guys know, we have access to books of account. Okay, as an auditor, we have access to books of account. So the trial balance are basically the raw financials. What's the debit balance and what's the credit balance? That's what trial balance is. Accounting framework and information system like Horizon's new ERP. You also have to dig into that. Financing structure and ownership, bank convenience. Have bank like gearing. Does the bank convenient require as a clause of gearing or not? A clause of liquidity or not? Business model and strategy, like what are the growing online channels? and industry pressure and economic environment. Definitely. And doing all through, the auditor can get a walkthrough of the organization. Basically, helping the auditor plan. That's why it's on risk assessment procedure and follows planning. Comes on the second step. All right. Now comes our favorite analytical procedures. As I said, as discussed in our classes also, analytical procedures are the plausible relationship between financial and non-financial data. Now, when I talk about payroll, what comes to your mind when I talk about payroll? Number of employees? Yes or no?
Yes, sir.
Yeah, payrolls. Now, what do you think about number of employees? Is it financial or non-financial? Financial?
Non-financial.
Non-financial. It's number of employees, right? So if I talk about number of employees and the exact salary that are getting. Now, salary is financial or non-financial?
Financial.
Yeah, financial data, yeah, because it's an expense for our company. So plausible relationship between financial and non-financial data is analytical procedures. Now, incorporating that with our example, as required ISO 315 risk assessment procedures getting a walkthrough. What the auditor will take out his lens and will do some ratios like inventory days. When he got to raw financial data of the company, the auditor calculated the inventory days and found that as compared to last year's, they were up. Now that's a basic knowledge. What are inventory days? Closing inventory, not necessarily cost of goods sold into 365. Yes or no? So that's like on an average how much a inventory stays. If the inventories days have gone up, what does that mean? Obsolete stock because the stock is not moving quickly. Overproduction, inventory is staying longer in the warehouse. Weak demand or inflated closing inventory. Then you can imagine okay, this is a particular risky area. And in ISA 330, auditor will respond to all the assessed risk. He also found out that the gross margin is down. Okay, after calculating the gross profit. So possible root causes, pricing pressure, theft could also one of the possibilities. Here the auditor is not concluding. Okay, he's just getting a walkthrough of the organization by doing risk assessment procedures. Cut-off issues or valuation problems could be there. That's why gross margin is down. And debt to equity is up. Okay. What could be the possible root causes? Increased management pressure to manipulate profit for lenders. So if debt to equity is up, they are gonna put more money in the business and generate more profit. Okay. So this could also be one of the reasons here the auditor is not at all concluding anything. He's getting a walkthrough of the organization. All right. Now comes the audit risk equation. Discussed plenty of time. Once again, like inherent risk, vulnerability, even before controls, like Horizon's pressure to hit EBITDA target. Do you think it is inherently risky? What do you say?
Yes, sir.
Perfect. What about control risk? See, systems and procedures in place. Okay, who's responsible for that? Management and those charged with governance, which are in place to maintain so that business achieves its objective and to maintain the integrity of financial statements. Now, let's say the client system fails to stop the error, like weak journal entry approvals. There is authorization, that is approval. We'll discuss what all things are there. Authorization, we have approval. Okay, if these are weak. So this both constitute for risk of material misstatement. That is driven by the client. Okay, risk Roma, whether risk of material misstatement is high or low, that is not on the head of auditor. It is always driven by the client. In this case, who's our client? Horizon. All right, that's why here Horizon has a beta pressure and this particular issue with internal control. Okay, this one only one is listed, but yeah, a lot of other factors is also going to be there. And detection risk is the auditor's safety net fails if samples are too small or procedures are poorly designed. That's on auditor's head. And overall is this overall forms audit risk. An inappropriate opinion is expressed. That is our audit risk. By the name itself, you can imagine if anything goes wrong with the audit, that's a risk associated with audit. Okay. So an inappropriate opinion expressed is audit risk. Clear till now?
Yes, sir.
Higher assessed risk is stronger auditor response required, lower detection risk. IR high, control risk high, so detection risk should be lower. Got it? Now comes materiality. If I talk about materiality is anything obscurance of which affects the decision making ability of users is materiality. Now, as in the first class also I explained an example. Let's say if I make a sales of $10,000. If I'm making a sales of $10,000, what do you say? Would I mind if there's an anomaly or a misstatement is required? But if I cannot find an account for this $1,000, do you think would I mind? Yes or no? And if I would mind, what's the reason? Don't argue that I'm frugal, that's why, but yeah.
Yes, sir. It will be material because it's 10%.
Yeah, exactly. It formed 10% of my revenue. Okay, so don't you think I am the intended? Definitely, if I'm the owner, I'm the intended user as well. So as the user, I will definitely mind if that. And would I mind if there's a $10 anomaly?
No, sir.
Yeah, exactly. So that's materiality. Okay, it could be amount wise, like the overall materiality based on the industry, you can set it up to, let's say, for example, 1 million. So anything above that is material. And below that, we set performance materiality. And why is it set? Like there could be different anomalies of $150,000. There could be one of $250,000. If I look at them individually, they are not material. But don't you think aggregately they can go beyond 1 million? Yes or no? So for
Yes,
that
sir.
reason, we have performance materiality, and all of this is done through professional judgment of the auditor. All right. So
Yes,
see,
sir.
user focused significance. An item is material if it could reasonably be expected to influence the economic decisions of users. So we have overall materiality, the limit for the financial statements as a whole. Okay. So that's why in the opinion statement, we say financial statement as a whole are free from material misstatement. And performance materiality, a working buffer. Okay, let's say if it's $1 million, so we can set it based on our professional judgment. Okay, by the way, at 800,000. Okay, to reduce the risk that individually small undetected errors accumulate into a massive problem. The nature exception. See, it's not always about the size amount wise of materiality. A relatively small unlawful payment to directors is material by its fundamental nature. So let's say there is a bribery happening with the directors of a company. If I set my overall materiality to $1 million, but the payment that was made was $100,000. Now, in this case, if you compare it with overall materiality, it is not material. But if you look at the nature of the transaction, what's happening is it's a breach, non-compliance with laws and regulation. So this is material by nature. Got it?
Yes, sir.
Perfect. Now comes benchmarks. Usually, what are the benchmarks? Now, profit before tax, revenue, total assets. See, metric is 5% of profit before tax you can take. Either if you're going with revenue, you can have a range of 0.5 to 1% of revenue. If you're having total assets, you can take 1% of total assets. These are not fixed. Everything is based on auditor's professional judgment. Okay, so when to use this, profits are stable and users are highly focused on operational performance. Okay, so let's say if the company is not stable, as in the sense they have 1 year they have a profit, 1 year they have a loss, in that case it won't be wise to use this as a metric. Okay, limitation ineffective is profit is volatile or unusually low due to one-off expenses like a provision. Okay, in 1 year if a big provision is being made, you can imagine the profit is very low as compared to last year. Okay, and revenue is what? when to use profit is highly volatile. In this case, if you cannot use profit before tax, you can use the revenue figure. Because revenue is like primary driver of the business operations. You know the sales, you can derive, right? Marginal or completely distorted. In this case, you can use revenue. And when to use the asset, like asset heavy entities or situations where solvency matters strongly. In that case, you can go ahead with it. And at the end, it's upon professional judgment of the auditor. Based on his past experiences with the client, with other clients, he can imagine, okay, in this industry, this is what works, so I'll be setting my materiality as per this. Got it? Now comes the fraud divide, the horizon threat. Fraud divide is basically ISA 240. Now, if you recall the definition, to obtain reasonable assurance whether financial statements are free from material misstatement, whether due to fraud and error. Now comes the fraud and error part. Fraud is intentional deception like override of controls or collusion between employees. All employees get together to commit and conceal a fraud. And errors is unintentional. Let's say as an accountant, I make a mistake of $500. Okay, so that's an error. Okay, and if I'm personally benefiting from it, that's why I designed the particular fraud, then that is intentional. Then that considers as a fraud. So in this case, particular case, what's going to happen with Horizon appliances? There is pressure, opportunity, and rationalization. See, bonus linked EBITDA targets and strict bank convenience. There's pressure of this. Okay. So vulnerabilities from recent ERP implementation, the opportunity is also present because the ERP is new. So they can, move around with the control system. Yes or no?
Yes, sir.
Yeah. Perfect. So there's also the opportunity and the internal narrative of it's a temporary fix to business. That's the rationalization. See, as human being, we also अभी ये पूरे काम कर रहा हूँ मैं, but उसका एक rationalization we always try to find कि भाई I am not wrong. ठीक है, but the reason why I'm doing this is because it's a temporary fix to protect. Look at the larger picture. Don't look at whether it is fraud or error. So for any fraud, there could be either pressure, opportunity, or rationalization. Here in Horizon Appliances case, as an auditor, look from the lens of auditor. What will the auditor see? Auditor will see the pressure. What will the auditor see? He'll see the opportunity. Okay, new ERP system. Okay, they can work around with this to conceal the fraud. And rationalization. What they can tell themselves, to go ahead with the fraud. Clear picture? And then he will design procedures. Okay, he'll look for something that could commit fraud. He will look for some particular anomalies regarding revenue, so on and so forth. All right. And always remember, management's job is the prevention. Auditor seeks reasonable assurance. Always remember that. Management cannot say that auditor should be getting me all the fraud related activities. Okay, it's not the job of the auditor. What auditor can do, and as per ISF 240 also, okay, what the auditor can do, he can perform procedures to check whether there are material misstatements because of fraud and error or not, and that is through skepticism, and that is present throughout the audit. Clear till now?
Yes, sir. Yes, sir.
Perfect. Now comes the ripple effect of laws and regulation. If you remember, we had ISA 250, no class, non-compliance. What happens in any industry? There are going to be fine. There are going to be penalties. If you are in a fast fashion industry, you also have to comply with environmental laws. So if anything goes wrong with this, just think logically. Would the intended user mind if we have done any non-compliance? What do you say? Would he mind?
Yes, sir.
Yes, sir. Definitely he'll mind. If you are investing in a company and the company is involved in some case and there's some legal prosecution going on with the company, so definitely you would be concerned with the future of the company and you would mind. You would mind a lot. So if there's a legal or regulatory breach, what is the auditor's role in that? So if it directly affects the financial statements, immediate adjustment are required. Like fines, legal fees, or mandatory provision. For example, in case of Horizon appliances, rising warranty claims under consumer law. Here, consumer law is important. Okay, so consumer law, if they are failing on creating the warranty provisions, basically that's no class. Non-compliance with laws and regulation. So if there's no class, so as per ISA 250, the auditor has requirements that he needs to communicate. And then comes the indirect ones, like the disclosure effects, future or conditional impacts, like, for example, leads to the recognition of contingent liabilities, altered risk assessments, and required communication with governance authority. What could happen and what could go wrong in the future, that is also required when it comes to non-compliance with laws and regulation. Auditor has a duty, and the specific ISA concerned with this is ISA 250. Clear till now?
Yes, sir.
Yeah, Madhav, all good?
Yes, sir.
Now comes strategy versus plan. See, think of it as an umbrella. Strategy sits over an audit plan. Strategy tells what, and basically, if I convert that into a plan, that becomes why. Why is basically the details. Overall strategy is the what and when. High level direction determines the exact scope, what's the scope of audit, timing, and general direction, and the allocation of audit resources, that who's gonna be in which team. Okay, don't write in exam कि वो कच्चा नींबू पक्का नींबू करके वैसे डिवाइड नहीं करते ऑडिट में, but yeah, that's audit resources. Audit resources are the team members that you have, junior auditors that you have, engagement partner. Okay, and depending on the requirements, you allocate them. Got it? And then we have the audit plan, the details, the exact how. So detailed operational execution translates the strategy into specific RAP risk assessment procedures. Okay, if you have identified something in the strategy, exact details would be contained in the audit plan. Planned responses and the exact nature. Okay, here it was overall. Here the exact nature, timing, and extent of testing that is required. Got it?
Yes, sir.
Perfect. Now comes the execution timeline. If you know, there is interim audit. And then we have the final audit here at the year end. So in interim audit, you can imagine that you can, walk around with the controls, and then based on your experience from interim audit, you can decide whether reliance on controls could be placed or not. So your interim work includes early procedures focusing on system understanding and testing controls. If controls and walkthroughs, like testing credit approvals to determine if sales controls can be relied upon. If sales control can be relied upon, then lot less substantive procedures would be required for that particular assertion. Got it? That particular transaction or account balance. If credit approvals and fine, so let's work on receivables, because auditor concluded that controls can be relied upon. Okay, so control risk in that particular instance is low. So auditor, based on his professional judgment, passed on that. Okay, fine. We have no issues with this, so we'll be relying on the controls. So that could be done during the interim work. And then the final work, that is year end. After that, you get audited financial statements. So year end focus is heavily weighted towards substantive, finalizing cutoff, year end balances, and final disclosures like inventory count, attendance, receivable confirmation. Okay, through that we obtain evidence. Evidence leads to conclusion, and finally opinion. Extensively discussed in the first lecture. Yep, this is how the flow goes like. We'll discuss about what exactly is evidence. Reliable, sufficient, appropriate audit evidence. Okay, so it should be reliable and relevant to the financial statements. Got it?
Yes, sir.
Perfect. Now comes our audit documentation, ISA 230. What if the auditor is challenged? Yesterday also we discussed this point, that any work that you do as an auditor, you need to document it. Because if in a case you are challenged, you are being challenged in the future in a court, then you should be able to prove your work. An audit documentation is basically an experienced auditor who has not been on the audit should be able to review your work objectively and conclude that, okay, the audit was conducted fine. So audit documentation is basically the written record of work performed, evidence obtained, and conclusions reached. Okay, कच्चा चिट्ठा आपका कुछ भी हो जाए, देखो मैंने ये किया था. That's basically audit documentation. If it is not documented, it is not done. क्योंकि वो तो ऐसे बोलेंगे proof दिखाओ. That is basically not gonna be a proof. So verification point 1 proves proper planning, supervision, execution, and review. Protects audit quality. Yeah, you can collect your audit working papers and use that in future audits, that this went wrong in this particular client's audit. Okay, then you can rectify in your coming audits, and in that way quality could be maintained. Provides evidential defense. And the quality check is verbal discussions are insufficient, definitely insufficient. Now don't go on to it, sir, according to Indian law, oral promise also forms a contract, so that could be placed as legal, but that does not work in that way, right? In audit, a material estimate challenge requires supporting analysis firmly on the file, not just a short conclusion. Okay, what exactly did you do? What was the sampling that you pick? In that way, a proper audit document is formed. Got it?
Yes, sir.
Now comes first is mindset, skepticism, and judgment. Business understanding, ISA 315 risk assessment procedure, risk and fraud identification. The equation triangle. What do we have? We have pressure. What else do we have? Rationalization and opportunity. The auditor will seek through this lens whether these three are present, and then he is going to perform procedures on particular fraud. Okay, rationalization and opportunity. And materiality scaling. Materiality could be nature wise and amount wise. Okay, that's defining basically the user impact. And strategic plan, strategy to detailed execution. We have audit strategy and audit plan, and documented proof, that is audit documentation as per ISA 230. Got it? See, planning is not mere paperwork, it is the intellectual design that guarantees audit quality and execution efficiency. And what do you say? Audit plan is stringent or dynamic?
Dynamic.
Definitely, it has to be dynamic because of changing circumstances. Auditor's risk of material misstatement could change moving along the lines, and he might have to do more substantive testing. Clear till now? Yeah.
Yes, sir.
Yeah. So we'll just briefly walk through these two sections of internal controls. But here, as this were previous presentations, so we'll be using different company names. So yeah, but for revision purposes, we have Horizons Limited only. So we'll discuss about internal controls, and then we'll talk about materiality so that it gets more clear. Okay. First, I'll go you through this. See, internal controls, this completeness, as you know, in the first class, we talked about assertions. In assertions, we have assertions are the representations by the management for transactions and account balance. Okay. And then you know that you have completeness, accuracy, cutoff, existence in it. Okay. Depending, what can you say as transaction, a revenue, and account balance as property, plant, and equipment. Basically, the balance sheet items. Okay. Now, what exactly is internal control? So internal controls are systems and procedures placed by the management okay, for the integrity of financial statements so that organization achieves its objectives. Okay. Now, for example, I'll talk you through one particular process. Let's say a customer order enters the system. So what's the risk that's surrounding it? Like there could be fake transactions ensued, missing transaction, or wrong data type. Genuine mistake? Yes or no? Then processing, like invoices generated. Now, what could be the possible miscalculation? Like data could be altered due to calculation or logic fails. Yes. Now, output is reports printed and viewed. So, output is incomplete or critical errors are ignored. And finally, storage or master file. Save to database. Unauthorized changes or permanent data loss if you do not have preventive controls. Okay, we have detective controls, we have preventive controls. So, first line of defense will always filtering impurities before they process. For example, you put in 10 invoices and the system processed only 4,80,000. So from an auditor's perspective, to check this particular control is working or not, what he'll do a range check. Like quantity 10,000 rejects if max value as allowed is 1,000. He'll do a sequence check, spots gap, like invoices 101, 102, 101, 103. So missing 103 is investigated. Field check enforces data type like name, field, rejects number, should reject number. And sign check prevents mathematical anomalies, sales entered as negative rejected. So if all those are working fine, then you can say that internal controls are strong because they are supposed to be designed in that way. And if anything goes wrong, system fails at that point, then auditor can conclude that okay, this particular system cannot be relied upon. Got it?
Yes, sir.
Yeah. So like we have processing controls, output controls, and master file. So objective is processed accurately and consistently. Like digit verification detects corruption, like account 12345 plus check digit 6 mismatch flag error. Here, ideally there should have been 6 digits. Now the control is designed in such a way that if there's a invoice number with dispatch notes number of 5 digits, it automatically flags it. That particular invoice could be further investigated by the management. Okay. And then reasonable checks like logical consistency. Flagging sales of 10 lakh with cost only of 100 rupees. Oh, it's a clear cut fraud. Okay. So yeah, then we'll further investigate that particular sale. Output controls like complete, accurate, and review. Control totals like comparing final output back to input. Exceptions report highlighting unusual items like sales more than 1 crore flagged for manual review. Makes sense because there might not be a lot of sales happening of that amount. Okay, so yeah, they would be flagged by the system and they would be highlighted that invoice number 182956. Okay, this is particularly flagged for manual review, and then that would be reviewed by the management. This is how the system is designed. Rejected items ensuring errors are corrected before final processing. Yeah. Then comes master. Strict access restriction. Who has the access to the sales data? Who has the access to the employee data? Preventive controls. Authorization, dual factor authorization, changing of password. That's basic one. Okay. Now comes the dependency trap. Application controls cannot survive a broken foundation. How come? Because information controls like range check or batch totals are entirely dependent on general IT controls. Now, you are having a doubt regarding general IT controls, right? Like general IT controls have what? Passwords, dual factor authorization. Now, if anyone has access to this information processing system, do you think that this particular controls could work properly? What do you say, Rachit?
Oh, sir.
No, definitely. So general lighting controls are like on the top. You have dual factor authorization, you have, fingerprint authorization, and
Firewall.
lots of, yeah. And even if a payroll system's calculation logic is perfect, if a hacker gains unauthorized access to the server, the entire system is rendered useless. Makes sense? Yes or no? So you can argue this in a particular auditor's response, right? The importance of general IT control. Got it?
Yes.
Access controls are password, two-factor authorization. One person not having the password cannot access the system. Change management like program changes rigorously approved. IT operations backup continuous monitoring. Now comes risk assessment. ISS risks. Are controls reliable? Case 1. Controls not reliable. Auditor does not test controls. Defaults to full substantive testing approach. If the controls are reliable, auditor executes test of controls, successfully reduces heavy substantive testing. Okay. Now, how the auditor is gonna test control? We have inspection. These are all procedures for control. Okay, not substantive procedures. Procedures for control. So if the auditor wants to respond to any particular control, is gonna do inspection. For example, checking physical or digital documents. For example, inspecting a purchase order to verify required signature. Observation, watching a process occur in real time. All right, then you can have re-performance, like re-performance of what? Reconciliation and so on and so forth. The auditor independently re-executing the control check. For example, recalculating the approval threshold. Or he can also re-perform reconciliation. Reconciliation is also a part of system of internal control, right? That one person has to do reconciliation weekly. So auditor can check one of the reports of reconciliation. He can do it also on his own. So if auditor has, like, he'll have a range check, like 5% deviation is fine. But if it's more than 5%, then he'll conclude that okay, internal controls are rendered unreliable. Then he obviously definitely we have inquiry. Inquiry with whom? The management. Asking questions of personnel, like note used for supporting evidence only, never stand alone. Acts as corroborating evidence that I inquired the management, they said the same thing. Got it? So these are the action verbs that the auditor is gonna perform: inspection, observation, reperformance, and inquiry. Got it?
Yes, sir.
Now comes evaluating operating effectiveness and calibrating audit response. See, for example, the deviation threshold, the auditor will set, okay, this much deviation is accepted. Okay. The isolated issue and system failures. For example, was the control applied? Was it consistent? Who applied it? Example, if the manager is absent for 10 days, okay, and no invoices are approved, the control has failed. Understood? So, for example, if there are few deviation, like example, one missing approval. So, in that case, isolated issues, controls effective, reduce the testing, reduce substantive testing. But in other case, many deviation, like 20% of invoices are not approved. An auditor, according to his professional judgment, will form okay, 5% it is fine. Now, in this case, it's 20%. What's the result? Controls not effective, increase substantive testing. Got it?
Yes, sir.
Perfect. Now comes one particular this. Usually, with revenue cycle, what happens is, ideally, what should be done? If you are selling something, have a good dispatch note. What is good dispatch note? Anything moving out from your inventory should have a code. Now link that code with invoice. So invoice number and the code, if they match it, they can, then you can see okay, rupees, let's say it was of 800, should have been recorded. So ideally, if there is GDN, which means inventory went out, right or wrong?
Yes, sir.
Yes. And if there's an invoice, then revenue should have been recorded. Yes or no?
Yes, sir.
Yeah, definitely. So a strong internal controls, how would it look like? You have invoice, you have goods dispatch notes, and you have a strong backend system. Okay, that when GDNs are generated, when invoices are generated, automatically the sale is recorded and inventory is ideally reduced. Okay, you can think of Zepto, right? I'm not talking Zepto has a GDN note, but they also have their own system of internal controls. The delivery guys, so that nothing goes wrong, they take pictures, like when they deliver, if you know. That also forms a part of control system. Okay, so that any theft, okay, or misappropriation, as in to say wrong parcel is not delivered. So invoice GDN. So when there's an invoice, so invoice will have a number, invoice will have an amount, and then the system If it's effective, then correct amount would be displayed as revenue. Got it? And correct amount would be displayed as cost of goods sold. So that is all. So for example, the control is credit checks and strict authorization. I mean, when we do revenue, it's not like we only do it on cash basis. We also lend it on credit basis. So for that, credit checks should be present. Okay, so the control here present is credit checks and strict authorization. So if a person is asking and demanding for goods worth 500,000, don't you think it would be wise for any company to have authorizations for that from upper management? Yes or no?
Yes, sir.
Yeah, definitely. So here there's a risk of fake orders. Like the fake orders, synthematics and okay, यहाँ पे कुछ generate होने में mistake हो गई. So here the risk is going to be a fake order. Like fake orders could be placed without credit approvals for inflating profit. Here control is sequential goods dispatch notes like GDN as discussed matched with order numbers. So you have order ID. Against the order ID, you have goods dispatch note, and against the goods dispatch note, you have invoices. And while testing this particular control, what I can do sequence check. Okay, 1:1:1. 2 should be is to 2, should be is to 2. Now, these numbers would differ definitely, but this is how I can do sequence check. And if there is any discrepancy among that, I need to investigate as an auditor. Got it? So goods sent but unrecorded. I have dispatched the goods, but I haven't recorded it. So goods sent but unrecorded, what's gonna happen? Revenue is understated. Cost of goods sold is also understated. Inventory is also understated because I haven't received anything about it, right? Wrong amounts billed. Now here the three-way match with goods dispatch note and automated price check. Automatically the system recognizes that there is a GDA, there is a corresponding or order ID with it and invoice attached to it. So if there's an order ID of this particular product, it can generate an invoice, right? And then record it in the revenue. Yes or no? Yeah. So there's a risk that wrong amounts are built. Here the control is sequential invoices and monthly statement. Right? You have sequential invoices like 28925 and then 28926. If there's any invoice missing, you can investigate about that. So sales omitted from ledger. There is a risk about that. If this control risk are there if this particular control does not work properly. The control is segregation of duty and bank reconciliation. Here the risk is of cash theft if the employees collude. Got it? If there are employees who work together to conceal the fraud. Got it? This is control risk. Then times discussed anything that influences the decision of intended user is considered material. Okay. So a business has thousands of transactions. Let's say a business earns a 3 crore profit and a 50 crore revenue. So 100 error is nothing. Rupees 100 error, even a rupees 10,000 error, a 10 lakh error to some extent is nothing. Aggregately, yeah, that could make up something. But yeah, a 10 lakh error, 5 lakh error, those are also immaterial because we have sitting on a profit of 3 crores. Okay, we do not check every 100 mistake. Without a filter, an audit would never end and costs would explode. Okay, the auditor's goal isn't find to end every error. The goal is to find errors that matter. That's why material. That matter word here is material misstatement. Misstatement, as you know, difference between what is required as per appropriate financial reporting framework and what is reported. Got it? Defining materiality, the first filter is all financial errors. Does this omission or misstatement influence decisions of users? If yes, then it's material. All the other stuff is immaterial noise. Okay, so materiality is not inherently about the size of the number. It is entirely about the influence on the users. If an error changes how a lender or investor thinks, it is material. Lender, bank. So if a covenant is breached, irrespective of the covenant is of $10,000, and overall materiality is of $1 million. So in this case, this 10,000 is going to be material because it is breaching the bank covenant. Got it? And now comes quantitative versus qualitative materiality. Quantitative is size based and qualitative is nature based. So, for example, the sheer volume of error compared to company scale. 5 crore of total asset, 50 lakh of overstatement, 50 lakh of overstatement. An inventory with an overstatement of 50 lakh in a company with 5 crore total assets. That's material. Okay. And here the context and consequences of the error regardless of size. For example, a 2 lakh error is tiny, but it drops the current ratio from 1.5 to 1.49. All right. So breaching a loan covenant and making debt immediately payable. So here, although 2 lakh numerical wise, it is tiny, but it is material nature wise. Got it? And perception. A missed 7 lakh expense turns a reported 5 lakh profit into a net loss. That's also material by nature. Gonna influence the decision making ability. Now, case trust, a 50,000 cash theft reveals a total breakdown in internal controls. This is also material by nature. Today it's 50,000, tomorrow it could be 1 lakh. Okay. And you can imagine what could happen in the future. And management integrity. This is important. So that's why this is material by nature. Clear with what is quantity wise and quality wise?
Yes, sir.
Yeah. Now comes overall materiality. For example, there's a company with a revenue of 50 crores, profits of 5 crores, and assets of 40 crores. So if I'm taking profit as a benchmark, let's say I'll have 5%. So I'll use 25 lakh as materiality. Whether to use 5 to 10%, the range in between, that is dependent on professional judgment. Okay, of the auditor. So just tell me logically, if the auditor finds that our risk of material misstatement is high, the company is inherently risky and controls are weak, is it gonna set the overall materiality low or high? Just be logical.
So, sir.
Yeah, definitely, because low risk of material misstatement, high risk of errors high. So I need to check. My professional judgment tells me that okay, set it low. All the transaction there are high chances of misstatement. Revenue benchmark profile, high turnover, low margin companies can use revenue as benchmark. So like 1% of revenue that becomes 50 lakh. Asset benchmark, like asset heavy industry like a manufacturing or real estate industry will use asset as a benchmark. Like 1% assets is 40 lakh. Materiality is never fixed, universal rule. It requires auditor's judgment. Important. Applied to the company's specific financial reality. Okay, special materiality, the strict exceptions in case of materiality. See, some areas of the business demand extreme precision. Like regardless of the overall materiality benchmark, even if overall materiality is set to 25 lakh, these areas are scrutinized at a much lower threshold, like directors, remuneration, related party transactions. You will learn that in SBR. It's not covered in FR, but related party transaction is there in SBR. Fraud and legal compliance. So if there's a 1 lakh error, here is highly sensitive, regulated, and critical to shareholders because it is concerned with director, integrity of management. High risk of hidden wealth transfers or conflict of interest. That's why it is material. Exception. Fraud and legal compliance, any indicator of fraud fundamentally shifts the risk profile of the entire audit. Let's say there's a pharmaceutical company. They did no plan. Okay, non-compliance with laws and regulation. Now we can imagine a pharmaceutical company. They had some breach of, the health standards were not maintained, and it caused a lot of outbreak in the particular this hospital. So if I quantify that particular misstatement, that comes out to be $5,000. Okay, overall materiality has been set to $1 million. So do you think this is material? What do you say? Hmm? Tell me. If there's a pharmaceutical company, uh, and that company had not compliance, made some non-compliance with laws and regulation, and there was an outbreak in the hospital. And if I quantify that particular loss when it comes to all the medicine that were lost and all that, so that comes out by $5,000. But do you think if I set my overall materiality to $1 million, is this 5,000 material in this case? What do you say?
No, sir.
Just think of it. Pharmaceutical company, non-compliance. I'm just quantifying if this was lost, but there was non-compliance. Don't you think it would have severe impact on the overall business risk profile? What do you say? So I believe this 5,000 should be material, that to nature wise. What do you say, Madhav?
Yes, sir.
Rachit, got clear?
Yes, sir. Clear.
Yeah. Any indicator of fraud fundamentally shifts the risk profile of the entire audit. That's why in this case, on the quantify, if I quantify the amount, it is very less. But it is a non-compliance with the fundamental. I am supposed to be a healthcare industry. And if something goes wrong like this, it's gonna tarnish my image. Got it? So it's very high risky. Now comes the risk relationship. Materiality and audit work share a strict inverse relationship. If audit risk is overall high, the materiality will definitely be lower, the threshold overall. When you lower the materiality threshold, smaller errors suddenly matter. Yeah. To catch smaller errors, the auditor must drastically increase the sample size and testing depth. So lower limit is harder work. And this is how you can relate to that. Audit risk, if IR is high, control risk is high, so detection risk should be low. And what the auditor has to do to maintain that this detection risk low, he has to work more. So that's why lower limit is harder work. If audit risk is high, the materiality threshold is low. Got it?
Yes, sir.
Yeah. The accumulation problem. Let's say if I set my overall materiality to 10 lakh. So if an auditor only plans their work around the 10 lakh overall threshold, individual small errors will slip through. But together they create a materially false financial statements. Yeah. So let's say I have an inventory error of 3 lakh, receivable of 2, expense of 2, and depreciation of 1.5, and this. So if total is 10.5, then okay, this particular makes sense. But here I want to know why to get till here, right? So let's say inventory error was like around 2.5 lakh. So then all of those won't be cashed, right? But still there are misstatements. It's not like $100. Those are little trivial amounts, $1,000. There are 2 lakhs, 2 lakhs, 1.5 lakhs. Okay. So here for this, there is performance materiality. So the auditor creates a safety buffer. Like there is overall materiality, the danger line of 10 lakh, and then performance materiality, the warning line of 6 lakh. Okay. To prevent accumulated small errors from breaching the danger line, the auditor establishes a lower working limit. So overall materiality is the final limit used to evaluate financial statements as whole, and performance materiality, the working limit. Okay, used to plan the audit, pull samples, and catch errors before they aggregate to dangerous level. It accounts for uncorrected and undetected misstatements. Got it?
Yes, sir.
Now, setting specific performance materiality based on inventory, cash, receivables, property, plant, and equipment. So the auditor, based on his professional judgment, can set for inventory if there's high risk complex valuation, and if there is high risk, then you can have to set the performance materiality lower. Cash, most highly sensitive and also most susceptible for fraud. So the lowest here receivables standard risk profile has been set to 6 lakh, and property, plant, and equipment stable, easily verifiable asset. So that's why here the auditor is, getting some relaxation. So, for example, there are receivables, total balances of 1 crore, and performance materiality has been set to 4 lakh. This is total balance, okay, not overall materiality. Now, 4 lakh is the PM limit. So, if the company name is Ember, by the way, if the defaults in any receivables, if they cumulatively get to 4.5 lakh, so then it is above the working limit, then the auditor is going to increase his sample size. So auditor's thus repose is definitely to increase the sample size, check more customers, and review bad debts heavily. So this is how performance materiality helps. If it was set to rupees 10 lakh, auditor would unnecessarily be relaxing, right? Yes or no?
Yes, sir.
Yeah. So this is how performance materiality helps. Let's say inventory. Total balance is of 5 crore. Now I have put the performance materiality to 8 lakh because as an auditor, I assessed inventory as high risk for the company Ember. So the warning limit here is 8 lakh. So slow stock 2 lakh, damaged 1.5 lakh, pricing error was of 2 lakh, count 1 lakh. All those misstatements cumulated to 8.3. What if I took it at 4 lakh? Or let's say I used a higher performance materiality, let's say at rupees 10 lakh. Then to 8.3 wouldn't have gotten catched. So it's all dependent on the auditor's professional judgment. So, okay, as an auditor, as a professional auditor, he recognized that inventory is of high risk. So performance materialities needs to be set lower. Okay, so that in comparison with the balances, all the cumulative misstatements gets caught. So in this case, search for systematic pricing issues, request immediate management adjustment. That's mostly on the response side. What's the auditor gonna do for this? Okay. Dynamic materiality when the goalposts move as plan is dynamic. For example, in year 1, the profit was of 2 crore. The materiality was set to 10 lakh. In year 2, the profit is reduced to 1 crore. So overall materiality drops to 5 lakh. The auditor must instantly expand testing to meet the higher threshold. He can't do anything about it because now when the profit is less, every penny matters more. So definitely materiality threshold is lower. So you need to work smooth. Shifting risk is prior year errors. What happened in the prior year 1 audit reveals many uncorrected systematic mistakes. In year 2 planning, auditor anticipates a higher error rate. In that case also, he'll set overall materiality lower. So performance materiality is defensively reduced from 7 lakhs down to 5 lakhs to act as a stronger early warning net. So lower PM increased detection risk in control. Clear?
Yes, sir.
Now, how it goes, set overall materiality, expect errors, set performance materiality, test using performance materiality, each balances, okay? Test using and then evaluate versus the performance materiality, do the aggregated errors in account breach the Ember line, basically the warning line, compare final versus overall, and then form an opinion. That's a different thing, okay? Material misstatement or not. Got it? Begin the session. Till now, times and time we have discussed, we have engagement, ISA 200, overall objectives of the auditor. Yes, then we have planning. Under planning, risk assessment procedures, materiality. Now tell me, will the auditor use a set benchmark exactly 5% or would it be based around his professional judgment?
Based around his professional judgment.
Okay, he can anchor around that particular benchmarks like 5 to 10% of net profit, but overall, the final overall materiality would be based on his professional judgment. How do you assess professional judgment? On the past experiences. The more experienced an auditor is, more professional judgment he has over a period of time. ISA 330 further audit procedures. What comes in the further audit procedures? Could you tell me?
The test of control and test of detail.
Yeah. Test of control and test of detail. This is all based on risk assessment procedures. Okay, getting a walkthrough of the organization. In risk assessment procedures, an auditor can do analytical procedures. Okay, so then he can prioritize. Okay, this is the risk. This is the auditor's response. And in test of control and test of detail, test of control is basically compliance procedure. A company has internal controls, and that will linked directly with audit risk. All right. And in the first session itself, we discussed about assertion, explicit representations by the management. Okay, so we have basically transactions and account balances. Transaction, you can say P&L items, and account balances, by the name itself, you can infer as balance sheet items. All right. So basically,
Yes.
management is saying, okay, this particular account balance, we have existence, right, and obligation, completeness, and valuation. For any account balance, what management is saying is assertion. What management is explicitly stating about that particular balance is assertion. So, for example, management is saying property, plant, and equipment. So, property, plant, and equipment automatically becomes a account balance. Now, it is the auditor's duty to check the existence, rights and obligation, completeness, valuation, and allocation of this particular assertion. So, for property, plant, and equipment, what does existence mean? Could you tell me?
That the property physically exists.
Physically exist. Exactly. If the management assertions representation by the management is saying we have this much of property, plant, and equipment. Now the auditor, through all of this checklist, can verify whether existence is there or not, whether the entity has the rights and obligation. Rights and obligation, basically the management although is stating, okay, this is a building that we own. What is auditor concerned with? Okay, do you really own that? Is everything complete? Like, have you properly recorded all the depreciation? Moving on to transaction, the P&L item. Okay, as to assertion representations by the management. Basically, management is saying that revenue occurred. Now, from auditor's perspective, he has to do all this checklist. Like, did it actually pertains to the entity and it occurred? How can the auditor do that? Like yesterday only we discussed about GDNs, good dispatch note. When a good dispatch note released, when there is a shipment. So by assessing that there is a goods dispatch note, can I say actually revenue occurred because I have dispatched the particular good?
Yes, sir.
Yeah, so that aligns with my occurrence. Cutoff. What does cutoff mean?
That transaction was recorded in correct accounting period.
Exactly. So let's say in India we usually have 31st of March. Okay. And internationally they use 31st December. Okay, so this is the financial year end. Okay, don't confuse it with auditor's report is signed and this date. So it is first of all approved and then audited financial statements are published. So these are financial year ends. Okay, so for audit is conducted for this particular period, like from 1st April for the financial year of 1st April to 31st March. Okay, so let's say a transaction occurred on 27th of March. Okay, a sale as per IFRS 15 was made. Now, management actually did not record revenue at that stage. Okay, they recorded it when they received cash on 4th of April. Ideally, what should have been done? Could you tell me?
They should have recorded when the goods were dispatched.
Goods
Basically,
were
when the
dispatched as per
control
IFRS
was
15.
control was passed.
Yeah, exactly. As per IFRS 15, when the sale transaction was made, they should have recorded revenue at a point in time, right? And when did they record? On 4th of April. Whatsoever may be the reason, but they recorded it on 4th of April. Now, as an auditor, I need to do cutoff testing. And if not done so, if it is not recorded on 27th March, then revenue is understated. Yes or no?
Yes, sir.
Similarly, cost of goods sold. What if they did not record the revenue but did record the cost of goods sold part of it, cost of sales part of it? So because of this, revenue is understated and cost of goods sold is overstated. Got it? That is basically cutoff error. Accuracy, the completeness. Okay, the invoice amount is of 250, then 300. So all the transactions that did occur are accurately reflected in the P&L also. Okay, and completely recorded. It should not be like the invoices of 250, only 240 is recorded, for example. All right. Interest is accurately calculated. That also comes under accuracy. So these are all test of details, particular assertion level transaction. That is where our examiner's favorite procedures come at play. We'll dig in detail ki how exactly do you deal with procedures. There are proper ways to it. Basically, procedure you can think of it as, okay, as an auditor, take on the coat of auditor and think, okay, this is the particular account balance that I am concerned with. Yesterday only we discussed about this materiality. We placed inventory as high risk. So definitely, if the controls are weak, I'll be doing more procedures for inventory. Now, when it comes to inventory, what comes to your mind? NRV as per IAS 2? Yes or no?
Yes, sir.
Yeah. So NRV is net realizable value. Now, as you know, this is judgment based. It requires management estimation. So yeah, you also know that auditor also requires to make his own estimate. So that also forms a part of procedure. That what is auditor gonna do with that particular thing. Now, if the auditor is concerned with valuation, okay, so he could hire his own expert, right or wrong. So it's all about the actions that auditor performs to confirm this particular assertion of valuation. Now, is it accurately recorded? Is it properly recorded as per lower of net realizable value or cost? That is what IAS 2 is concerned with. What is IAS 2? Are set criteria, appropriate financial reporting framework. Okay, and through this procedures only he'll obtain evidence. And doing all this, he'll form conclusions and then opinion. Okay, revised?
Yes, sir.
Perfect. Madhav, good to go?
Yes, sir.
Perfect. So see, before we begin, this is basically the COSO framework. Like the 5 components of internal control, what exactly management has to do. Remember, it is the responsibility of management to have sound system of internal control to maintain the integrity of financial statements. Now, if I talk about what are control environment, like active oversight, clear authority lines, and disciplined review. Basically, the environment in which the entity is operating. Okay, so if the top management has a say about that risk should be taken as a priority, you should not be doing this. That's basically your control environment. And then comes risk assessment, the entity's process for identifying business risk. And then information system and communication, because we are operating in the modern world. So yeah, it can't go without this. So capturing and sharing data like customer master data controls. Because as you know, there is customer master data file. I mean, list of all the customers, list of all the data and all. Okay. So what is your organization doing to protect all the sensitive data? Control activities as you know, the actual checking steps and physical controls. Your segregation of duty. All right. Segregation of duties and reconciliation. These are your actual activities that are forming part of your internal control system. And then monitoring. Like it's an ongoing process, you also actively monitor it, ensuring controls continue operating effectively over time. And that is what an external auditor is also concerned with. All right. Now, the key takeaways are internal control is a system, not a single check. Okay, controls affect risk assessment. Definitely they affect risk assessment because if control risk is low, detection risk, I'm not saying that he should be keeping detection risk high, but yeah, वो है ना थोड़ा आराम रहेगा ऑडिटर को. An audit approach. Management owns control, external auditor only assess them. Got it?
Yes, sir.
Yeah. Moving ahead with this. This is what you are concerned with in exams. Key the 3-part weakness. You first identify what is the weakness in internal control and then we'll link it to our Horizon case. Remember, we are dealing with Horizon Appliances Limited. Okay, it's a listed company and we all know that inventory, whatever were the high risk warranty claims, internal audit is outsourced and all that. Okay, so in your exam, when you've been given about control recommendation, it is usually this pattern. First, we identify the weakness and what could be there. If you are identifying the weakness, you obviously want to tell the management that because of this particular deficiency, there is this implication. And then finally, you give a recommendation. First, state exactly what is missing or failing, be it lack of segregation of duty, okay, be it not having proper authorization line, okay, And what are the implications to it? Like explain what misstatement like could lead to revenue being understated, could lead to inventory being overstated. Fraud or loss could arise because of that weakness. And finally, what are the recommendation? भैया आपने इतना बोल तो दिया, अब ये भी बता दो कि क्या कर सकते हैं. So give a practical control improvement, naming who should do what and how review will happen. Naming as in not the sense कि okay, we'll hire Vijay only for review. But now you can have one particular employee if in a case there's lack of segregation of duty. So this is how you should be addressing to get complete marks. For example, in our case, if let's say there's a weakness of one person creates suppliers and approves the payment, so I'm stating exactly what is going wrong. So after that, I'll list its implication. Fictitious suppliers could be created and the money could be transferred to that one person's account. We have discussed it. This is how fraud happens and unauthorized payment. Okay. And what this could lead to? Understatement of cash, overstatement of cost. Yes or no?
Yes, sir.
Yeah. And recommendation would be separate setup from approval with independent review. Yeah. From approval, basically segregation of duties, you can do that with independent review of any of the tasks performed by all of this. So one person should be creating the supplier and one person should be authorized to approve the payment. So this is how it should have been ideally done. So, but the important part is you should have to clearly list that this is a particular weakness you are targeting. What are the implications to it? So think of it whenever you're answering, think of it logically. So good to go?
Yes, sir.
Perfect. Now comes design versus operation. Yesterday also we discussed that we do inquiry, observation, inspection, and reperformance. Okay. So like obviously inquiry is gonna be the weakest because every employee is gonna everything is fine. Basically, auditor sits and asks the employees of the company that how are controls working. So let's say you are like an employee of the company. Naturally, if you want to protect your employment, would you be like, sir, यहाँ पे सब धांधलेबाजी चल रही है? Would you be like that? Tell me.
No, sir.
या डेफिनेटली वी यू वोंट. माधव आपका कुछ है कि आप सत्यवादी बनोगे?
कभी कभी तो रहना पड़ेगा सर.
अच्छा ओके, बट आपके जॉब का सवाल है तो आप ऑडिटर को सब बता दोगे?
नो सर.
Okay, definitely. So yeah, in terms of hierarchy, when an auditor tests internal control, it's like inquiry, observation because auditor is actually seeing that. Auditor is actually observing inventory count to happen. Okay, so obviously that's better than inquiry. Then inspection of document, inspection of any data entering. Okay, and then finally reperformance. Reperformance includes like doing reconciliation. The auditor by himself does the reconciliation after it has been performed by the appropriate personnel. Okay, so when auditor does a particular work by his own, so that's the most reliable. In terms of evidence also, we have different hierarchies. Okay, now comes general IT controls. General IT controls, so you know, function support reliability of system overall. Example, inspect user access listing, who has the access to the data, test password settings, review change management approvals. This is from auditors. How can auditors do test of controls? So if auditor is concerned with general IT controls, what he'll be doing, inspect user access listing. So okay, by that he can confirm okay, appropriate users only have the access to system. And then application controls are basically operate within specific transaction streams. For example, in horizon sales cycle, inspect sales order. This is test of control procedure. Okay, inspect sales order for credit approvals before dispatched. Inspect three-way matching. So don't you think by this the auditor can come to know whether the system is working properly or not, and then based on his professional judgment, he'll assess whether to place reliance on internal controls or not. Got it? Yeah. Got it till now?
Yes, sir.
Yes.
Yeah. Perfect. Now comes ISA 610. What is ISA 610? You know, internal audit. Any company has internal audit. Like just like we have external audit, we are external audits. Okay, the practitioner is an external auditor, and for listed company, this is required by statutory law that your financial account needs to be audited. Now, most of the companies, most of the public companies who can afford, okay, it's not like there's a small company, they should also be doing that. So in most of the company, there's an internal audit. Internal audit, basically they are not only concerned with financial statement, there could be value for money audit as well. So how the processes are working and whether funds are efficiently utilized or not. आप इसे ऐसे समझो कि एक अंदर ही डिपार्टमेंट है कि बिफोर एक्सटर्नल ऑडिट कैचेस वी आल्सो हैव आवर ओन इंटरनल ऑडिट डिपार्टमेंट which is comparatively more independent than rest of the employees. Because if you want a sound internal audit system, the internal audit should ideally be reporting directly to audit committee. And what audit committee is composed of? Non-executive directors. Although they are never going to be at the level of external audit when it comes to objectivity, because basically they are the employees of the company. But still, a company has its own internal audit function. And yeah, ISS 610 is basically using the work of internal audit. Remember? Internal
Yes,
audit. Okay, and we had ISS 600. ISS 600 was management expert, right? And ISS 620 was, could you recall? Auditor's expert. Okay, so in ISS 600, if management has employed any particular expert, when it be it property valuation, be it share valuation, be it share-based payment valuation, an external, if the management has its own expert for a particular assertion, from auditor's perspective, what he can do? Check the competency, capability, right? And reasonableness. Yes or no?
yes, sir.
Perfect. So what are the major differences? Like internal audit is supposed to provide assurance and advisory, okay, both of operational reviews or value for money or fraud, internal environment for the checks in system. And here the reporting line is to management or board, and primary user is governance inside the entity. Okay, they primary users are not the intended users that we discussed for external audit. In external audit, these are stakeholders and shareholders. Here there's government. Basically, the board and management wants it, what is working properly and what is not working properly in the organization. Okay, an ideal internal control system would be when the internal audit, okay, internal audit is reporting directly to the audit committee. If this is not done so, then it has implication in external audit as well. If internal audit is not reporting to the audit committee, then external auditor would be like, okay, I cannot rely on that work because independency is hampered. And as you all know, external audit is opinion on true and fair view of financial statements to shareholders and external stakeholder market. Okay. Now here comes reliance. Whether reliance could be placed on internal audit or internal control is a judgment. Always it's a professional judgment, not an automatic entitlement. Criteria for external reliance is the external auditor must assess the internal auditor's competence, objectivity, reporting line independence, just like we discussed regarding audit committee, and the nature quality of work performed. Definitely. And in our case, what's happening is Horizon outsources its internal audit for IT and ERP. Okay. If they report only to the finance director, objectivity is compromised. Okay. And if they report directly to the audit committee, then auditor can place more reliance. Okay. Definitely that has to go through the filter of his professional judgment. But yeah, this is usually the case. If they are reporting directly to the finance director might want to work things in his way. So here objectivity is compromise. Got it?
Yes, sir.
Yeah. Now comes assertions. Once again. Management's implied explicit claims without assertion, substantive procedures become a random list. That's definitely. So occurrence existence is typical is confirmation, inspection, physical verification, reperformance. Completeness, search for omission, sequence check, supply statement, GRN matching. And valuation is recalculation, analytics, estimate challenge, subsequent event. And for cutoff is year-end cutoff, ledger review, disclosure checklist, minutes review. So all of this are not exactly test of details, but always remember you have control procedures and the normal procedures on test of detail. So if I'm checking existence, I'm directly targeting that particular account balance. But if you can see here, I also have inspection of document. I'm doing sequence checks. So through sequence check also, I can do some test of controls as well. So for example, if the management has a control system of sequence check to match GD and GRN on all this. So if I'm implementing that, so I'm testing both test of control also and test of detail to some nuance. Okay, we'll discuss about that, how that is there. But when it comes to this audit risk and auditor response, so there's a mix and match whenever you read any particular answer. Yeah, always remember as an auditor, we prioritize risk, and what the auditor, an ideal experienced auditor should be done should be auditor's response. Okay, now comes, sorry, audit evidence. And as we'll discuss about the list, we perform procedures, and through procedures we get evidence, and from evidence only we perform conclusion. Okay, now if you look at the definition, they state that there should be sufficient, appropriate audit evidence. From previous classes, the thing what have we discussed? What exactly is appropriate?
So, relevant,
Hmm.
reliable.
Exactly. What is relevant? That
Assertion.
directly test a particular assertion, right?
Yes, sir.
Yeah. So if there's a document that directly confirms that this particular buildings belongs to the entity, so that, do you think that is relevant?
Yes, sir.
And reliable is basically the source. Okay. So see, sufficiency relates to quantity. By the name itself, it is like sufficient. It should be like, it's not like only one should be there. And yeah. And appropriateness relates to relevance and reliability. Now coming on to reliability, how can I say that this particular evidence is more reliable? Stronger is external confirmation, auditor reperformance, original third-party documents, directly observed procedure. Okay, as you know, external auditor is the most independent here. Okay, so if let's say from auditor's head, I am asking the bank to give me a confirmation letter for the balances held by the company. Okay, first of all, it's done by the auditor itself. And secondly, bank, do you think bank has any incentive to not give the balances or incorrectly state the balances? No, because auditor is also independent and bank is a third party confirmation. So this acts as the most reliable evidence. So if the evidence is the most reliable, so you can have less quantity of that. But if it's less reliable, so you have to corroborate it with other evidence. Like moderate or internally generated evidence supported by effective controls. If the controls are working properly, then yeah, you can show the reconciliation reviewed independently as an audit evidence. If the internal controls are strong, then comes the weakest one. Pure inquiry, unsigned explanations internally produce tools with weak supporting control. If you're submitting this, then yeah, okay, you can have them. Okay, we also inquired the management, but if there are external confirmation, so yeah, those are going to be the most reliable. So as an auditor, you need to make sure that there are sufficient appropriate audit evidence in place. Okay, got it? Like internal, external. Now, external is definitely gonna be more reliable than internal and auditor generated. evidence like re-performance observation by the auditor is definitely gonna be more reliable than management representations. Got it? So best combination is external and auditor generated. Auditor from his phone's letterhead is sending bank asking for confirmation of balances. Okay, so that's gonna be the most reliable, right? Got
Yes,
it?
sir.
Perfect. Madhav, revise over.
Yes, sir.
Perfect. A small amount of highly reliable evidence is P like अभी कौन सा चल रहा है? It's GOAT. It's the most goated evidence. Okay. So external and auditor generated is the most goated evidence. Goated evidence forms strong conclusions. Okay, reliable conclusions. Beats the mountain of weak evidence that is base. Okay. Now comes audit technique. And just what exactly are the audit techniques? If you remember from the previous classes, we discussed about analytical procedures. So, is our analytical procedures used only at planning stage, or there are some additions to it? Tell me. First of all, analytical procedures are plausible relationship between financial and non-financial data. Now tell me, analytical procedures, are they used just for planning stage as you discussed yesterday, or can they be used at substantive and review stage? What do you say?
Yes, sir. It can be used at different stages.
Yeah, exactly. So use at planning stage as substantive evidence where predictable data exists, and also at final review. Final review, how come? Because at final review, you have recent data. Okay. So if you have recent data, then you can, okay, check whether from the last year, is it matching or not? From the last 5 years data, is it matching or not? And then we can, apply it to our own case that our company had EBITDA ratios and all. So that's why in the final review stage also we can use analytical procedures. For example, testing payroll expense using staff numbers. That's here payroll expense is financial data, staff number is a non-financial data. That's why plausible relationship between salary bands and increment rates. What has been happening in the previous year. So you can do that in all the three levels. Okay. Now this staff number, you can use that if you are checking for that payroll expenses. Don't you think analytical procedure and substantive test would help as a proper audit procedure? What do you say? Yeah,
Yes, sir.
definitely. Now comes accounting estimates. Say in IFRS also, you have plenty of time to discuss things like claims. Provision is liability of uncertain timing and amount. Yes or no? Definitely. So don't you think it requires, it's very highly subjective, it requires estimation by the management, be it
Yes, sir.
NRV, net realizable value, different types of provision, all those required management judgment. Now, when it comes to management judgment, auditor from his side also has to give his input. So, like judgment based areas are highly sensitive to management bias. They don't want to create higher provision. Although it might be required, it might be unreasonable to not create higher provision. Okay, like demand elevated professional skepticism. Definitely. So from auditors end, you require higher skepticism. So for Horizon example is challenging warranty provisions using historical claims and detect data. And as you remember, we can do this at three stages. First of all, auditor can use historical data. Yes or no?
Sir.
Yeah. First, a simple one. Okay. Right now, the management has made a provision of let's say 2.5%. Okay. So getting back 5 years, like 5 years ago, let's just place it year 5, 4, 3, 2, 1. Usually the claims were 2.6%, 2.8%. Yeah, so it ranged from like 2.2% to 2.8%. So management usually made a provision, and during that time, we also would have 2.6% is the actual claim rate, and we would also have the claim that was represented by the management for provision. So if the deviation is very less, then okay, auditor could say, okay, based on the past experience, management is experienced in this area, so there's no much need to, get his own lane. And one thing that the auditor can do is make his own estimate. How this could be done? See, for example, I'll take an example of merger and acquisition. Okay. So you guys know as per IFRS 3 how goodwill is calculated and all. Okay, so let's say the management is showing that 2 million is the amount of goodwill that is recorded. And auditor, by applying some of the procedures, came to know that business is impaired. Now, as you know, as per IFRS 3, goodwill should be tested for impairment annually. Okay, and management has not impaired it. So what auditor will do? He'll properly value the merger and acquisition and then calculate the goodwill, what actually should have been recorded, and test whether an impairment is required or not. That is basically auditor making his own judgment. Goodwill is also a judgment. Okay, testing for impairment is also a judgment. Got it? Yeah.
Yes, sir.
Perfect. Now comes our sample. Is audit sampling based, or we just go through each and every data? Tell me.
We take a sample.
Yeah, definitely. That's the practical way, right? That's the way in which audit is conducted, because business has loads and loads of amount of data. Okay, we have thousands of 2,000, 3,000 transactions going on every month. So definitely, auditor has to select a sample. Basically, you can think of it as a big bucket and you having a small glass. So that's called sample. Okay, and then you extrapolate that for the rest of the population. Okay. So selective testing with logic, not guesswork. Structured selection is statistical or non-statistical. Like we can, as discussed in the previous classes, we can do is first of all calculate the population. Okay, and then we can assign. First of all, generate a random number. That could be used using any tool, even Excel. Okay, and then list, let's say I'm talking invoice number. Okay, and the first random number is 25. And based on the sample size and the number of this, I've got an interval of 500. So to collect the sample, what I'll be doing is first invoice I'll pick off 25, then adding 500 to it, then I'll pick up 525. In that way, I'll select the samples and then perform procedures on this particular transaction or invoices that I've selected. This could be done for receivables as well. Okay, so that is statistical structured one. We can also do, auditor can also do haphazard selection. Okay, now this is based on auditor's judgment, so it is not that reliable. You cannot say, okay, so it could be like auditor turning on pages and then selecting randomly selecting this part. Okay, and there is also block selection. Block selection is basically you picking onto a number. Let's say the business is operating in different regions. The different regions, so you will be selecting the particular invoices from the month of February from the West region, and find that okay, everything was fine in the Feb month in the Western region, everything was fine for the February month, but actual misstatement were there on the Eastern region in the month of March. Okay, so because of the haphazard selection, because of block selection, this couldn't have been done. Okay, so there are statistical methods like you can assign random numbers and do stratification of data as well. Stratification is basically 0 to 500, and then that you can do this interval. And after that 500 to 1000, you can also do on that. Okay, remember we discussed all of this in detail, right?
Yes.
Yeah, got it, Madhav?
Yes, sir.
Perfect. So like sample testing revenue cutoff around year end. That's a normal one. Now comes defeating management bias. This is basically how and this when there are judgment, what you can do. Test management method, review data assumptions, model design, and the approval process. Is there math and logic sound from past year data? Develop an auditor expectation. Build an independent benchmark or alternative estimate, just like I discussed about merger and acquisition. Management is saying something, but if I develop my own estimate, that would be the most reliable. Does our independent calculation match their booked figure? If not so, I'll communicate that with the management. And finally, review subsequent events. So let's say you had a warranty claim. You made a warranty claim provision. So after some time, actual claims are going to be happening, right? Previously, we discussed that with the past data. But in actuality, also management is going to pay out for the warranty claims, no? So review that also. So use later evidence to judge whether the original estimate looked reasonable or not. So did post-year end reality align with any guesses? Guesses are basically, don't use this word, basically provision. Okay, so that makes up for management evidence. Now coming to our case. In the Horizon case, a possible lawsuit over faulty Horizon appliances. Auditor reviews post-year end legal letters like subsequent events to test management's claim that no outflow is probable. Got it?
Yes, sir.
Perfect. Now, a smaller topic of automated tools and technique. Now, definitely we are in 2026 in the age of AI. So how can audit be left behind, right? So automated tools and techniques are basically the tools that help the auditor in terms of audit. Be it talking about small example, be it the tools which generate random samples, because machines do not have an incentive for any particular client. Okay, so this extends the auditor's reach across full populations rather than relying solely on sampling. So some of these like material transaction, they can completely, because it's automated, identifies anomalies and unusual patterns in digital records. Automated tools do not replace skepticism. Do remember that. Judgment still sits above the tool. So for example, isolating duplicate supplier payments. This could be easily tracked by a tool, right? Tracked by a particular software. Identifying journal posted outside office hours. Okay. Basically, the system is giving you red flags. There's a problem in this. There's a problem in that. Okay. Spotting credit notes issued immediately after year end. This could also be implemented. And the work of others. Expert and service organization. Remember ISA 402? Yes or no?
Yes, sir. You told us yesterday.
Service organization. T1 and T2 report. So what happens is, let's say there are material balances in an organization, be it payroll. That function has been outsourced to other organization. Now, because this is material, auditor wants to know, he's concerned with this particular company's audit. Now, it is not in-house, so he cannot be like, okay, this is how it's done. Mostly data is fetched through service organization. Now, the auditor will ask the service organization for a T1 report. What are the internal controls in place? And if he wants a detail, he will get a T2 report, basically proving the operating effectiveness of the control system of that organization. Okay, now if this is all right, then he can rely on the data provided by the service organization. This is applied when there is service organization in place. There could be payroll function, accounting function. The accounting is too huge, okay? If you are saying that, then yeah, audit needs to get there. But if there's a particular transaction happening there, the service organization could be contacted. And finally, there is auditors expert. Remember, we had management expert and we also had auditors expert. Remember, and in Horizon's case, if you remember, the new ERP system was implemented. So if new ERP system is implemented, don't you think from our end also we should be hiring some IT specialist? What do you say?
Yes, sir.
Yeah, perfect. So there are management experts that management has hired, but to get the audit work properly done, we also have auditors expert. Definitely. So using external valuation like specialist machinery or service report like outsourced payroll. So Reliance never removes the external auditor's finance responsibility for the opinion, assess competence, objectivity, and relevance first. Be it the management expert or the external, like who we are hiring. Okay, so if let's say I do hire my own specialist for IT, so can I delegate my responsibility that although I am responsible, but I have used quote unquote this particular expert, so my opinion is modified because of him. Can I do that? Can I delegate my responsibility if I'm using an expert?
No, sir.
Definitely not. See, the responsibility of audit opinion always lies with the external auditor. It's not like he can delegate that quote unquote I have used this particular audit opinion. So yeah, that is because the reason why I have modified the opinion. That is never the case. Moving on to detailed procedures, we'll talk about one by one. But as we discussed, assertion to procedures here are the high yield procedures. Okay, high yield procedures are basically the highest yielding marks procedures. You will get complete marks for it if you do this. So external confirmation, it has been plainly written, but this is now not how a procedure looks like. It usually starts with an action agree. Okay, inspect, and then what are you doing to confirm the existence? Okay, so attend physical counts, for example, of inventory to confirm existence and valuation. I'm just stating a rough procedure. Do you agree with me? Sorry, existence and completeness. Because yeah, through that I can know now whether it is complete or not. Existence I can see, and what am I doing? I am attending the physical count. If I'm attending the physical, that also more so sort of like how exactly the action is being performed by the employees of the company. So I can also, if I'm doing that at interim level, think of it. Think like an auditor. If I am assessing that at interim level, attending the physical count, and if by that time I confirm that okay, it's highly reliable, don't you think that is going to help me at the year-end procedures? Yes or no?
Yes, sir.
Yeah. So like what is it proving? It is proving existence. It is proving valuation rights or cutoff. Oh, sorry, not valuation, but it is proving existence. Okay. Now let's take an example of property, plant, and equipment. The classic one: inspect, title deeds, and supporting documentation to confirm what? Rights and obligation of property, plant, and equipment. As you can see this pattern, what is the auditor doing? He is inspecting. He is either inquiring, he is observing, he is either agreeing to the total, or taking a sample out of a sample. It is usually placed like this. It's not a template, but yeah, it works for like from out of 8 procedures, you can use this template to form 4 procedures. You just need to make sure what exact assertion are you testing and what are you gaining out of it. It could be evidence. Like here in the case, inspect title deeds, that's your evidence. So if it confirms the existence, that title deed is going to be your evidence. External confirmation, let's say for example, I'm having bank cash balances. Okay. If I'm getting a direct external confirmed letter from the bank, don't you think that's like the goated evidence? And I'm also performing a procedure? Yes or no? And through that external confirmation, what am I confirming? I'm confirming, first of all, rights to that cash balance and existence also. That actually cash balance is there. Got it?
Yes, sir.
Yeah. So just quickly skimming through. Tomorrow we'll discuss like 1 to 2 procedures for each and every like material statement, like for inventory. So let's say if I'm concerned with receivables, usually there is a chance that they might be overstated, or in some cases they might be understated. Okay. So like the key assertions here are existence. Do they actually exist? What are the valuations? Okay, if you have high levels of debtor, if you are a bank, for example, don't you think you will be concerned with
to whom you have granted the loans, it is not always like you're going to recover the full amount. So valuation is also an exercise placing there. Okay, that you have lent person A, I'm just talking in layman terms, rupees 10 lakh. But now because of financial difficulties, you can at max recover rupees 5 lakh. So ideally it should be valued at 5 lakh only, no? That concerns valuation. And rights and obligation as discussed. Do we actually have the right from that receivable to get money? Do we actually sold goods to them? And finally, cutoff. When it occurred on 27th Feb, irrespective, let's say the sale occurred on 27th of Feb. Irrespective of when the cash was received, if it was sold as per IFRS 15, we should have recorded it there. And what would have been the journal entry? Simple journal entry: debit receivable and credit sales. Right?
Yes, sir.
This should have been done. This is what according to appropriate financial reporting framework. Misstatement is what? Difference between what is required and what is actually reported. Okay, it was required this, it was not reported at this. So this is a misstatement. And if the amount is material, then it's a material misstatement. Okay. So what are the high yielding procedures for all this? External confirmation, post-year and cash receipts. Yeah, makes sense. If you are receiving cash from that receivable, so yeah, you have that. You prove the existence. Aging review, expected credit loss review, that helps with valuation, and sales cutoff testing. Okay, year end, you take a sample and check whether GDNs was there, goods were actually dispatched or not. Okay, goods were dispatched. If money was not received, ideally that amount should have been reflected in receivables. If it was not done so, then yeah, there's an understatement of receivables. Okay. Talking on to inventory, first thing that comes to mind is existence. Definitely inventory count. Completeness, yeah, 5 units pertains to the entity. 5 units should be recorded. Valuation, lower of cost or NRV, and cutoff. In the case of receivable, cutoff relates to whether the sale was made. So ideally that particular receivable should be recorded in that particular time period. So in case of inventory, what happens is usually in a manufacturing company, it forms cost of goods sold. Okay. So if inventory is sold, inventory, okay, in the audit, inventory is basically what you sell in the ordinary course of business. Okay. So for a builder, the flats would be inventory, not assets. For a car manufacturer, the cars would be inventory, not assets. That's common accounting knowledge. Okay, so what happens is it forms a part of cost of goods sold. So if let's say you sold a car on 26th of December, ideally what should have happened? If the control is passed, you should have recognized revenue in relation to that car. Revenue should have increased. At the same time, cost of goods sold should also have increased. Okay, so if you are not doing that in the right financial year, that's a cutoff error. Clear till now? Yeah, obviously. If you're selling a car, definitely you incur cost. That's how you generate revenue. No? So if any of this does not happen, if you have correctly stated the revenue, but you have misplaced when it comes to cost of goods sold, so that's a cutoff error in regards to inventory. Got it?
Yes, sir.
Perfect. Now, what can you do about that? Like attend count, so that also proves some existence. Test counts, inspect cutoff after year, review the NRV, aging, confirm third party holdings if your inventory has been held. Like just car dealers have this arrangement that there is a car manufacturer and then there are dealers. Okay, control is with the car manufacturing only because they are not selling the cars to the dealer. They are just having an arrangement and commission based arrangement. Okay, so risk and rewards is retained by the car manufacturers. If there are third party holding, we also need to confirm that the company is showing that we are having 5 cars in our inventory. So yeah, they are being held at this particular showroom. Got it?
Yes, sir.
Bank and cash, the most important one. Existence, rights, completeness, and accuracy. Okay. So bank confirmation, most reliable evidence. We're just talking about evidences here. We'll talk about exact procedures. Okay, in the coming tomorrow's session. One procedures from the major balances. So review, reconciliation, inspect clearance after year and petty cash count. All those forms evidence.
Okay, one must be more reliable, one must be less reliable. Okay, like review is going to be less reliable than auditor performed reconciliation. Got it? That's simple and basic. Inspect clearance after year end, petty cash count done by the auditor. And always remember, if the auditor is doing petty cash count, it is always in observation of a supervisor. Okay, that's common. वरना पता चला ऑडिटर पे ही इल्जाम लगा दिए कि आपने चोरी किए हैं पैसे. ओके, इतना चिंदगी कोई नहीं करेगा, बट या. So when you are, writing this as a procedure, petty cash count, always do that in front of CCTV or a supervisor, authorized person. Okay. Non-current asset. Yeah, you can also add on to surprise cash counts because people are not ready for that, and there are high chances it could not be concealed if there's some anomalies happening at that particular department. Okay. Non-current assets, existence, most important, rights, valuation, and completeness. So what are going to be the reliable audit evidences? Inspect purchase documents, also form best, most reliable evidence, and title deeds, physical inspections, review depreciation, and disposal for completeness. Okay, so if there has been disposal, so it should have been accurately reflected in the financial statements and an accurate amount should be displayed. So if there are disposal, so completely account for that. So that is how the account balance is going to be accurate and complete. Got it?
Yes, sir.
Perfect. Now comes revenue. All everything starts with this only. Revenue, cost of goods sold, then you have gross profit, operating profit margin, and all. So obviously there are chances that revenue could be overstated or either understated. Okay. So the key assertions are occurrence because it's a transaction, not an account balance. The cutoff, ideally when it occurred, it should have been recorded there and there. Accuracy and complete. One of the most highly reliable procedures and audit evidence would be trace dispatch notes to invoices. Remember we discussed about good dispatch notes. If these are present, then I can confirm that this particular transaction occurred to the and pertains to the entity. And that way I am targeting the assertion of occurrence. And then I can do review credit notes. You see, we have credit notes. Okay, after year end. Basically, credit notes ki okay, confirmation, sort of confirmation that we have receivables for that particular revenue. Now, obviously, you won't be issuing credit notes if you haven't made credit sales, right? Yes or no?
Yes, sir.
So although it makes logical sense that you are, as an auditor, you are reviewing the credit notes after year end. Journal testing, substantive analytics on margins and trend. What exactly were the gross profit margin and are they aligning? Just think of it. In year, let's take a horizon of 5 years, 1, 2, 3, 4, 5. I'll have an industry benchmark that usually the gross profit margin ranges between, for good companies, industry standard is 5 to 10%. And we Horizon Appliances Private Limited, limited, public है हम, ठीक है. 1, 2, 3, 4, 5. In year 1 it was like 3.5%. Yeah, good, normal. 4%, really good. You're now having like the bottom. Then it went to 6%. Great. 4 was also like 8%. And year 5 it suddenly went up to 11%. Upper range of what is the industry standard. And there is also an incentive of EBITDA. Remember?
Yes, sir.
Yeah, so this is how you have to think as an auditor. So in year 5, doing analytical procedure planning style, you find out, oh, there is a risk that revenue is overstated. Now design high yielding procedures out of it. This is how it is done. Payables and accruals. Payables are your creditors. Accruals, like let's say you have utility expenses, electricity bill and all. Okay, and we obviously follow accrual base of accounting. So let's say in the month of January, you incurred an expense of $5,000. Okay, and you did not pay it. So what it is going to be? Your current liability. Basically, it is going to accrue. Okay, if it hasn't been paid. Okay, now what are you concerned with when it comes to accruals or payables? Definitely the completeness. Whatever is there should be there in the financial account. It should not be omitted in any way. The valuation, what is the exact value for the, let's say, payables? He might have given some discount. Yes or no? or cutoff. Cutoff is like the same. Like supplier statement, most reliable evidence, supplier himself is stating that we owe this much. So that confirms the valuation. Post year end payments, most important. So let's say the company is showing an accrual of 5,000 and in post year end with the exact same corresponding account of utility payment, there has been a payment of 5,000. So that also in a way confirms. Unmatched good received notes, review accrual calculation. This is also analytical procedure. So you can think of analytical procedure. This is a substantive stage. Okay. Got it? Now comes provisions. Liability of uncertain timing and amount. Completeness, valuation and presentation. Here, review the legal status in case of some litigation happening with the company. So the best possible case would be no bank statement. You're not going to be asking about bank statement whether you paid or not. Definitely you're going to be reviewing the legal letters in corresponding with the legal team of the entity. Subsequent events, whether payment was made or not. Basis of estimate of management assumptions, were they reasonable or not? And finally, the disclosure review as per the requirement of IAS 37. Got it?
Yes,
Share
sir.
capital and remuneration. Occurrence, accuracy and presentation. Okay, whether properly split among share, nominal share capital and share premium at face value or not. Director's remuneration properly stated, and you can confirm that with the bank statement. So inspect board minutes. Here minutes, it's board minutes. Filings, contracts, payroll records and recalculation. These are all highly reliable evidences. We'll talk about what are the exact procedures that can yield you complete marks. But always there's a pattern. Auditor is doing something to target a specific assertion. In return, he is getting okay. He is confirming occurrence. In return, he is confirming the accuracy. To get to there, what exactly is the auditor doing? And through that, audit evidence is produced. Okay, and based on that only he forms conclusions. And conclusion is eventually reported. Got it? Now applied risk responses at Horizon Appliances. Coming on to the interesting part. Audit risk and audit responses. Now these are shorter ones, but you can get an idea if you are given a proper case. So here there's a revenue cutoff risk. Good dispatched on 2nd April recorded as March revenue to hit EBITDA targets. See how beautifully it is linked. So what would be the auditor's response in this case? Substantive cutoff testing comparing dispatch dates to invoice dates. Okay, in that way you can confirm. These are shorter responses, but you get an idea what is done here exactly. Putting onto the Horizon Appliances cases. Here there was receivable valuation concern. A large customer
Sir,
overdue by 140 days with zero recent cash receipts, which means receivable is overstated. You can further add on to that. Got it? What's the auditor's response? Challenge expected credit loss estimates, verify post-year end receipts if there are any. Okay. Auditor is not gonna
sir,
be like, yeah.
in the first one, they are
Hmm.
comparing GDN with invoices.
Yeah, goods dispatch notes with invoices. And then yeah, see these are smaller notes. Actually उसने ना condense कर दिया, generate कर देता है. So further you can test with bank receipts or either credit notes.
Okay, sir.
Cash receipts and credit notes. This is not a full-fledged answer. इतने छोटे नहीं होते. If you look at like our ACCA, so they even refer कि there is a possibility of classification error as per IAS 16 and there could be overstatement or understatement. इतना detail में जाना है.
Yes,
ठीक है?
sir, they
And
write consequences.
yeah, exactly. Consequences are there, but here we are just getting a gist when it comes to Horizon Appliances Limited, what could be an alert. Okay.
Yes, sir.
Now, inventory valuation. Like older product model selling below cost after new range launch. So I'm concerned with the valuation. This is a risk. Okay. So response would be review NRV against current selling prices, challenge inventory write-downs. This is, you can say, sort of a procedure in place. Okay. There are two other things that the auditor can do in a proper audit risk and response question. Got it? Going concern pressure. Bank covenant breach post year end, waiver not yet confirmed. Waiver is basically whether bank is continuing in and providing further finance or not. Waiver is not yet confirmed and ban convenient was breached post year. And if you're like breaching one convenient, so definitely there's a going concern pressure. If this has been shown, there are going concern uncertainty, and definitely management does not want to do that. So the response would be review subsequent correspondence with the bank, assess borrowing terms. These are very short, but you get an idea what exactly the auditor is going to do. And provision understatement for warranty claims. Yeah, rising warranty claims on new products. Legal advice says outflow is probable. So I am concerned with, as an auditor, I am concerned with provision understatement as per IAS 37. Here they have beautifully listed, says outflow is probable. So if outflow is probable, you have to create a provision as per IAS 37. So auditor's response would be review legal letters, definitely. Okay, what are the claims saying? Test management's method for calculating warranty reserve, be it evaluate, make your own estimate, make auditor's own estimate. Things that can be done from auditor's perspective. Begin the session. Engagement, planning, evidence. Yeah, yesterday we discussed about evidence, and as per the audit, as per the objectives, as an auditor, we have to obtain sufficient appropriate audit evidence. What exactly is appropriate? It should be relevant concerning the exact assertion, and it should be reliable. Where is it coming from? Is it internal? Is it external? Okay. Third party confirmation done by the auditor are the most quoted evidence. So, less sufficiency relates to the quantity, okay, less or more. So, if a audit evidence is highly reliable, so I can say that okay, you can have less of that to form a proper conclusion. But if it's less reliable, if it's internal, then you have to obtain more and more corroborating evidence to do so. So that is where sufficient appropriate audit evidence comes in. Now then, how evidence is obtained? Either through procedures, okay, or the auditor can receive direct confirmation letters by bank depending on the transaction or account balance. So today we are gonna deal with conclusions. Basically, we'll try to form some procedures around some particular important transactions and account balances. And then we'll discuss opinion and how finally that all consolidates into an auditor's report. Okay. So, first of all, once again, we are sticking to the same company, that is Horizon Appliances Limited. So the entity profile is mid-size listed kitchen appliance manufacturer. Operations include 2 physical warehouses, a rapidly growing online channel, and a recently implemented ERP system. Okay, that's fine. Internal pressures or management compensations create significant inherent risk. If we discuss that, contributes to inherent risk. Executive bonuses are tightly tied to earnings before interest, tax, depreciation, and amortization, and profit before tax targets. So, okay, that creates an inherent risk. Environment is risky. If inherent risk is high, so definitely risk of material misstatement is also high. Okay. The active audit risks are rising warranty claims. We have gone through that. On a newly launched product line, a strict ban convenient is currently linked to gearing. So there's a chances of misstatement there, and interest cover. Okay, an internal audit function is fully outsourced. So there comes ISA 402. We have to either obtain T1 or T2 report. Okay, so this is the client that we are dealing with, Horizon Appliances Private Limited. Now comes are receivables and revenue. One is account balance and one is the transaction. So you know the particular assertion to target, like for account balance, it is existence, rights and obligation, okay, classification and all. And for revenue, it is occurrence cutoff and all. Okay. So for assertions of revenue, the core are occurrence, existence, cutoff, accuracy, and violation. So what are the chances? Because of the pressure, what do you think is going to happen if the management bonuses are linked with EBITDA? There are chances of overstatement of revenue. And when revenue is overstated, don't you think receivables might also be overstated? What do you say? Yeah.
Yes,
Definitely. So like overstated revenue directly equals to overstated receivables as well. So prime evidence, what could be the prime evidence that we can obtain for receivable and this? External confirmation is strong but not magical. Non-responses, disputes, and weak processes require alternative procedures like post-year-end cash receipts review. Okay. And what is cutoff criticality? Errors turn real transactions into misstatements. Focus heavily on dispatched document. Now, transfer terms and post-year end credit notes, will talk about that in terms of receivables. And with respect to Horizon appliances, what exactly is happening? High management pressure to boost EBITDA. See, so dramatically increases the risk of early aggressive revenue recognition so that they can get their bonuses. Okay. Now, the specific attention required on the online channel dispatch cut off exactly around the year-end boundary. Now, let's just try to make some. Okay, some procedures, proper procedure. Now you know if I'm concerned with revenue. Just do one about receivables, okay? Let's just say I am concerned with the receivables. Okay, what can I do? Could you form some procedure, some detailed one that can get you full marks? Okay, what can you do about receivable? First of all, this is
Obtain external
account balance.
confirmation.
Yeah, external confirmation. But exactly, see, the art is, as we have discussed in our classes, we can have positive confirmation from all the debtors that we are having, basically the receivable. So positive confirmation, that is one thing. And if they reply, this positive confirmation is gonna be our evidence. Now, the important thing to crack here is how exactly do you write the procedure. So can I say send, basically what the exactly is the auditor doing? So send positive confirmation. Directly to customers. And what if they fail to do so? And follow, you can take follow up on non-responses. So here comes the part of alternative procedure. So if everyone is not gonna respond, so as an auditor you have to do alternative procedures. So what is the alternative procedure that you can do? Can I say by checking receipts, and then you can match them to supporting invoices. Now don't worry, you don't have to write this much of, but I want to say, see, here the important part is, first of all, send positive confirmation, that's good. Okay, but when you read that particular thing, alternative procedure, you just that keep in mind, because this is a particular alternative procedure that you can do. Okay, now what exactly can you do? Just think about it. If some of the receivables, they are not replying to the follow-up, so what could happen? By checking subsequent cash receipts to supporting invoices. So if there are cash receipts, then you can say that this receivable exists, they are complete and they do actually exist, because no one's gonna pay you if they don't owe you. Got it? So these are alternative procedure. Positive confirmation is the most reliable evidence if they confirm that we owe the company this much. Got it?
Yes, sir.
Yeah, what else we can do? Batao. Yeah, think of it. GDNs, connect something with GDNs, good dispatch note.
Recalculate the receivables turnover period.
Recalculate the receivables for, yeah, that's more of like valuation side of things now. How much receivables do you exactly have? But that's a very vague, like incomplete. Recalculate the receivables. That's not gonna fetch you more marks. Okay. So if I am concerned with occurrence, okay, if I want to prove that this particular transaction
I mean, basically, revenue is a transaction, receivables are account balances. So when revenue occurred, then only receivables are created, right? So if I want to target as a occurrence is basically whatever pertains to the entity is recorded. So that particular sales, let's say I made a sale of $5,000. Okay. If I made a sale of $5,000, did this 5,000 actually, does this pertain to the entity? That is basically occurrence. Okay, so for this, what can I do? What do GDN stand for? Good dispatch note. So can a GDN be created if goods are not dispatched? What do you say?
No, sir.
So if the goods are dispatched and they have a corresponding invoice, so can I say this particular transaction occurred to the entity? This particular sale occurred to the entity, and then okay, finally I can also say okay, receivable exists because revenue occurred. And then that's a different thing how I'm gonna perform on the receivable. So for the occurrence of revenue, what can I do? Think of a procedure around these two. What can you say? So can I say select a sample of receivable balance? Receivable balance or sales balance also you can say. Okay, it's not like receivable balance because you want to prove the occurrence. So receivable balance and trace them to and GDN to confirm recorded revenue actually occurred to the entity. Occurred. Can I say this? Yeah,
Yes, sir.
does make sense. Got it, Madhav?
Yes, sir.
Perfect. Now comes inventory. What comes to your mind when I say inventory? Obviously, has been posted so many times. IAS to lower of cost and NRV. So that is basically a judgmental area also, and also concerns with valuation. Right or wrong? Hmm?
Yes, sir.
Yeah. So inventory, that's an assertion of account balance. In that we have valuation. Yeah, all the story. So in terms of horizon, what's happening? We have two physical warehouses plus new ERP system. So don't you think there's heightened risk around cycle counts, discrepancy, investigation, and pricing transfers? According to this only, you have auditors' responses. That's how you become a pro. Right. So first of all, think like an auditor. In the terms of our client, that is Horizon Appliances Private Limited. When I, debriefed you about the entity profile, there they had two physical warehouses. So inventory count, all those generic procedures are definitely there. But specifically in terms of inventory, heightened risk around cycle counts, discrepancy, and investigation because of pricing transfers. So here the trap is count attendance proves existence. Okay, and completeness but not valuation, because valuation is what judgmental. So whatever estimation management made about NRV, one of the procedures can I do, I can check the post year end bank receipts and confirm with how much it coincides with the NRV that management stated. Is it overstated or understated? Yes or no?
Yes, sir.
Yeah, so it's pricing and cost accumulation, obsolescence and net realizable value, and cutoff verification. Now yeah, that's only third party confirmation. Like inventory held somewhere else required direct information and examination of supporting evidence. Just like in a case of car manufacturing company, the inventory is held with the dealer. But as you know, the risk and reward still lies with the car manufacturer. So what does that mean? That we as an auditor needs to make sure if there are third party,
If the inventory is held by third party, so we have to, have supporting evidence relating to that and what's the exact amount through which we can value the inventory. Okay. First of all, confirm whether this belongs to the entity by rights and obligation. So if the control has not passed, the risk and reward stays with us. So basically, car manufacturing company has the right to the inventory. Then you can say, okay, the inventory exists and the inventory is owned by the company, and then further on procedures. Okay. Now, so if so, I want this inventory. If I'm talking about inventory, what can I say? Could you perform? Just draft me one procedure around this inventory.
Observe inventory account to ensure that inventory physically exists.
Yeah, okay. Existence and completeness, just like discussed in the previous slides. Okay, perfect. But you just have to frame it like, either you can say observe or you can even attend. Attend is I believe, better. So can I say attend inventory count and also perform test counts? Okay, that is perform is done by the auditor. Okay, test counts, the results from this would be more reliable from count sheets. What has been counted and what has been entered in the count sheets. Okay, to physical inventory. And vice versa also can be done. So there is no discrepancy. To confirm existence and completeness. Can I, draft this? Yeah, you know exactly which. Okay, to confirm existence and completeness. Okay, so now I know exactly which lesson I am targeting for this and what exactly am I doing for that. Do you guys agree with this particular procedure? Make sense?
Yes, sir.
Perfect. What else can I do? Like a normal NRV procedure. Hmm. What do you say? What else can I do? If I am concerned with NRV, lower of cost. See, here again, once again, I'll remind you, IAS2 is our set criteria. Okay. Set criteria is basically appropriate financial reporting framework. So what does IAS2 require? Lower of cost and NRV. So this is required. And what is reported? We don't know for sure, but we'll design our procedure around that. What exactly is reported? NRV is reported, but is it accurate? That is why we are performing. The difference between what is required and what is reported is a misstatement. Okay, and we are just responding to misstatements. Okay, auditors respond to risk of material misstatement. Okay, so what can I design? How can I design a procedure around NRV?
For a sample of inventory items, compare their sales value with the cost.
Yeah, good one, good one. Yeah. So for a sample of agree to can I agree to purchase cost, purchase invoices and compare them with NRV?
Yes, sir.
Yeah. To ensure lower of cost or NRV, right? Yes or no? What do
Yes,
you say?
sir. Sir, can you also write sales invoices?
Yeah. See, inventory. So yeah, I believe purchase invoice of that particular good would be better because it's either cost or NRV. So the purchase invoice would have key originally uh, for how much it was purchased, and then I'll compare it with NRV. So NRV might be lower than cost now. So that is what. So Sales is a different thing, right? Post year, and if you want to compare, like management made an estimation about NRV and post year receipt for that particular good, okay, that also confirms whether it was appropriately recorded at NRV or not. Okay,
Okay, sir.
yeah, perfect. Clear, Madhav?
Yes, sir.
Perfect. Now comes our bank, cash, non-current assets, and equity and reserves. So bank and cash, simple in form but carrying exceptionally high sensitivity to misappropriation. So there are high chances that it could be stolen. Okay. And then what else do we have? Bank confirmations acts as the best prime goated evidence when it comes to bank balances. Bank confirmation ki bank directly confirms, okay, this is our client and this is the balances that they have in their bank balances. So reveals undisclosed loans, charges, guarantees, reconciliation, post year and clearance review, all those on an audit evidence. Non-current assets are physical, like valuation, true ownership, and proper depreciation. That is what I am concerned with when it comes to PPE, property, plant, and equipment. And the set criteria here, as per appropriate financial reporting framework, is going to be IAS 16. Okay. So any misclassification thing happening, anything wrongly capitalized, you can get over it. Like whenever you are reviewing any answer, you might have seen, first of all, they are referring to there might be misstatement as per IAS 16. IAS 16 requires this. There are chances that this might not have happened. And because of this, what are the consequences? Either the asset is going to be understated and expenses are going to be overstated. Got it?
Yes, sir.
Existence via physical inspection, that's your like most generic one. Okay, to confirm the existence. Ownership via purchase title, docs, valuation via depreciation and disposal proceeds. And then comes equity and reserves, that is legal. See, when it comes to authority, I am just concerned ki whether board approved it or not. What is the classification? Like appropriately split between share nominal capital at face value and share premium when it comes to share. And what about reserves? It is actually required by law or not? So here there's heavy reliance on legal documentation, like inspect board minutes and statutory records for share issue authorization and director's remuneration. Okay, so all those are equity and reserves, non-current assets, and bank and cash. So as usual, we'll do this once again. Hmm. Yeah. So let's just do one simple for bank and cash. What can I do? Let's just draft one procedure around bank and cash.
Reconciliation.
Reconciliation. Okay. Yeah, but how? Reperform reconciliation. See, reconciliation is the exact. We can do reconciliation where the auditor can definitely reperform. It also counts as like the most relevant things the auditor can do. So, as you said, reconciliation, but can you frame it properly? Agree to what? After agreeing to what? First of all, have the action verb. So the auditor is basically reperforming, right? So reperform bank reconciliation, yes or no? And agree bank statements, checking for outstanding items. And to do, because of this, what am I gonna get to ensure accuracy? Got it? This
Yes, sir.
is, I confirm this. I reperformed and I just reperformed what? Bank reconciliation done by the other employees, okay, of the company. So through that, my reperformance is an audit evidence only, right or wrong? Because it is auditor generated evidence. It's gonna be more reliable than internal evidence. And bank reconciliation, this is what am I reperforming? And agree that particular after reconciliation and agree that statement checking for outstanding to ensure accuracy. What else can I do when it comes to bank and cash? The quoted one. So can I obtain direct confirmation? The most quoted evidence, direct confirmation from bank for balances, loans overdraft. Yes or no? And guarantees. To verify what? Existence and completeness. Okay, because when the bank is providing me with the balances and if I'm checking it with the company's financial statement, so if anything is missing, that also concerns completeness. And if bank, do not confirm any particular balance, so that also questions the existence. So through this procedure, I'm targeting this both. Clear with this? Yeah,
Yes, sir.
Yes, sir.
perfect. Now let's just do some for non-current assets. Yeah. What can you say about non-current assets?
Existence, rights, and obligations.
Yeah. So can you frame 1 to 2 high yielding procedure around that? What can you draft?
The examined title leads to ensure company
That's
owns
an
the
obligation.
asset.
Yeah. But if I want existence, so physically impact, so I can get information about the condition as well.
Yes.
Yeah. So if I'm targeting the assertion of existence, what can I say? Physically. So physically is the action. Fixed asset register, right? So now think of it this way. Physically inspect, I'm going to the buildings. If there are 3 buildings, so and agreeing them is basically this is my financial statement. I'm having an account balance in it. So physically inspect assets and agree them to fixed asset register to confirm existence. Got it?
Yes, sir.
Yeah. What else can I do for non-current assets? See, you might be tempted to write like this, recalculate depreciation. Our brain stops there, right? Till here, every student can figure out that recalculate depreciation because I know okay, auditor recalculates and depreciation and accuracy to ensure accuracy. But the better way to frame this is like, what can you do? Is recalculate. This word is absolutely fine till now. So depreciation is also fine, but for a sample of asset. And if you are recalculating, so basically you're ensuring this consistency, accounting policy, yes or no, and accuracy of
Yes,
carrying
sir.
value. Now, does it make sense?
Yes, sir.
This is a very high quality procedure. See, by reading this, you might think, okay, तो मैं लिख सकता था, right or wrong?
Yes,
After
sir.
reading, there's no rocket science in it. See, recalculate depreciation, each and every student would think. Okay, when it comes to property, plant, and equipment, just do the recalculation. But just think of it. Why am I recalculating depreciation for a sample of assets to ensure consistency? Whatever the account policy is adopted by the company, is it accurate as per that or not? If they are applying revaluation property, are the depreciation amounts, expensed in the P&L account? What about the revaluation surplus and all? So all that ensures consistency and accuracy as well. So clear till this? Non-current assets.
Yes, sir.
Yeah, perfect. So now let's just do about about liabilities. These are our payables. What can you think about liability? Account balance.
Obtain external confirmation from payables,
From bank, if there are loan outstanding.
from creditors.
From creditors, yeah. So what can you say? Can you say that supplier statement? Hmm? Can you call them as a supplier statement?
Yes, sir.
So can I say obtain supplier statement? Okay. And what can I do with the supplier statement? And reconcile them with the payables ledger. I would be having the payables ledger, right? That is basically why it's an account balance with the payables ledger, right? Yes or no?
Yes, sir.
Yeah. So through that, what can I? What's the output that I'm getting after doing this?
Completeness and accuracy.
See, you can, creatively also play invest. Oh, sorry. Spell. Investigating any differences, right? To ensure basically completeness only. All liabilities are recorded. Yes or no?
Yes, sir.
Got it? Yeah. What else can you think? For completeness only, you can work around that. So can I review post year end payment from bank statement? Because unnecessarily no one is gonna pay, right? Until unless they owe. Payment from bank statements, and from where do I have to compare? I got my post year payment from bank statement. So can I trace them to supplier invoices? Like this particular supplier owes me $10,000. So if there's a transaction, so through that, don't you think I can ensure completeness? What do you say?
Yes, sir.
To identify unrecorded liabilities. So if there has been a payment, but it has not been recorded in the supplier invoices, okay, there exists. So that is incomplete. So identify unrecorded liabilities. Okay, clear with liabilities? So these are very high quality procedures. It is not expected that each and every 5 of the procedures that you are writing are of the same length. Okay, but this examiner cannot deduct your marks because he'll say, okay, you have written review or post year and payment from bank statement. This is very high quality procedure. If you just write recalculate depreciation, so obviously that's begs the question, okay, this is half written provision, and also it might seem like okay, you have ratified it. Okay, so this is how you draft procedures over time when you practice, so it'll get easier, right?
Yes,
Okay,
sir.
yeah, clear, Madhav?
Yes, sir.
Now comes liabilities, provisions, and contingencies. Liabilities we have discussed. Provision is basically a liability of uncertain timing and amount. And contingency, we don't know for sure whether the payment is gonna be there. Depends on the situation. Okay, happening or not happening of a particular situation. So search for unrecorded liability, post year end payments, just like we discussed. We have already created like may indicate omitted liabilities. So that ensures completeness, right? Supplier statement reveal unrecorded invoices, unmatched goods received notes. So good received before year end without a payable. So that is also understatement, right? If you have already received the good, okay, but you have the GR and you have received the good, but the corresponding entry is not in your payables ledger. So that's understatement of payables, right?
Yes, sir.
Yeah, that is up. And when it comes to provision, so there's the risk of understatement. Completeness is the primary assertion, and it is under pressure, delay invoices or minimize provisions to improve reported profit. Okay, and we also have that pressure in horizons, right? Now, provisions versus contingencies is what requires intense judgment combining legal correspondence, probability analysis, and measurement. So for Horizon, rising warranty claims on the new product line require carefully assessed mathematical provisions, not just contingent disclosures, because warranty provisions, as you know, are required. Okay. How do you? One is legally required and one is promised. So if your firm promised, so based on the past practice of the firm, you have to create a provision because there's a probable outflow. Got it?
Yes, sir.
Now let's just yeah, let's just have one with this provision. What can you draft around provision? Yeah.
In assertion, we can check its valuation.
Yeah, valuation. What else? See, provision is a judgmental area. Yes or no?
Yes, sir.
Yeah. So whenever it comes to provision, can I say review action verb? So review management's calculation and underlying assumptions. To assess the reasonableness of provision. What do you say?
Yes, sir.
Yeah, perfect. What about contingencies? Less than probable. The outflow is less than probable. That's why we have contingent liability. So what can you do? And usually it's about legal. So we do not have a specific context. So can I say, can I obtain written representation? ISFI 80. Because yeah, this is the best you can do. Obtain written representation and review legal correspondence.
So do we have to write the ISA number in response?
No. No. It's just I was just highlighting it.
Okay.
Not at all required. It's just then you click now written representation as if IIT, how it goes. Like when you do not have, because what can you say when there is no contingency? So for receivable, you can have external confirmation. For this, can you have?
No, sir.
So that's why written representation and review legal correspondence. Yeah, legal correspondence you can have, but you cannot be like hum judge साहब के सामने sign, right? So what from auditor's perspective, what he can do, obtain written representation. Okay, whenever someone asks, even if he is challenged about his working, he can have. Okay, regarding this contingency, I was having written representation from the management. Got it? And legal correspondence to do what? Or to confirm the existence of present obligation. Got it?
Yes, sir.
Yeah. Perfect. Now, mm, let's just frame one around equity. What can you form around equity? See, always whenever there's equity, inspect. Board minutes are basically the documented evidence of what was discussed in the board meetings. So board minutes and statutory record, because like whenever this is equity, this is listed, so definitely that's gonna be statutory. So statutory records. Can I say this? For proper authorization, here authorization is an important one. If it was authorized, then only you can proceed. Okay, equity share was properly issued. And completeness regarding the movement in statement of changes in equity. Got it? Can I say about this for equity?
Yes.
Yeah. So this was for equity. Now moving forward, it is not like we are always auditing for public companies. There are small and medium enterprises. So what comes to your mind when I say small and medium enterprises? More owner intervention? Yes or no?
Yes, sir.
But these are small medium enterprises, so you cannot command them or expect them to have a dedicated internal audit department, audit committee, and all that, because definitely they have to manage costs, so they cannot be like for segregation of duties will have five employees. Okay, so this particular is an advantage because there is more owner intervention. And what was the need for audit? Okay, managers and the shareholders are different, so that is why an external practitioner was required. But here in this case, in some cases, small medium enterprises, they might not require for themselves. Okay, because they are interfering in the day-to-day operations of the business, and definitely they won't be deceiving themselves. But there are situations like they want to apply for a bank loan. Now bank requires audited financial statements. In that case, small medium enterprises might run into a need for audit. Okay, so and audit principles remain identical. Definitely, it's not be like if for smaller entities it's gonna change, but the operating environment changes, the available evidence, yeah, and the way risks manifest. Because for a small and medium enterprises, the control risk is mostly gonna be high. Why so? The challenge here is weaker segregation of duties due to fewer staff. But evidence shift is heavy reliance on owner managed review is insufficient, necessitates vastly increased substantive procedures and direct observation by the auditor. Now comes non-for-profit organization. See, public companies, they are working for profit, they have financial statements, they have statements of changes in equity, you have management integrity. But what about the organization who is not working for profit? So here there are no managers, as in the same, but there are trustees. Now trustees are concerned with, because trustees and donors, you make donations, right? So they are concerned with whether the funds that they are providing, and this organization obviously has an objective. It could be like feeding, it could be like education to the underprivileged. So donors and the trusted, they are concerned whether the funds that they are providing, the organization is benevolent to their funds or not, whether they are utilizing their funds in the way they intended or not. So here also, there's the situation changed. In that case, there was stewardship concept. Here also there's stewardship concept because they are trusting their money with them. Okay, I want to donate for this particular cause. So organization is supposed to deliver on that. May not be in profit. So here what's going to happen? They are mostly reliant on volunteers. So you can imagine that mostly donations might be coming in the form of cash. So how they are collected. So at a deeper level, there are also some organization who might be, used as a money laundering scheme. So here the challenge is differing objectives, complex income streams. Okay, and there's no structured way. Okay, they also have an equity because yeah, they are not listed. They are not working for the profits. And stringent donor conditions. So here the evidence shift is gonna be focused, pivots heavily to restricted funds, grant compliance, conditions of donations, and the completeness of physical cash collection. This is really important. If there's gonna be an audit for NGO, so how the cash is collected. Okay, the risk of misappropriation of cash is really high. Okay, so the definition of audit does not change, just the environment changes, and accordingly the auditor adapts. So here the control risk is high, so detection risk must be kept low. Here also inherently risky. This is inherently risky, and there's no question about control risk, because definitely there's not going to be segregation of duty and all that, because this organization, they have 3 E's. Like the funds that they provide should be economical, efficient, and effective, because they are not concerned with profits. Got it? How the auditor would respond when it comes to small medium entities and non-for-profit organization. Clear?
Yes, sir.
Perfect. And reporting stage. So, okay, based on the conclusion that an auditor has received through the evidence, okay, then only he'll form opinion. So let me just skim you through what are the types of opinion. And when it comes to this, types of opinion, here now we have the series of ISA 700, basically ISA 700 audit report. Okay, so the reporting standard. So we have ISA 700 is an unmodified opinion that an auditor, in his opinion, there is no material misstatement, and the financial statements present a true and fair view. So when I broadly talk about audit opinion, we have first of all unmodified opinion. Okay, there are no material misstatement. Then there are modified opinion. Within the modified opinion, we have further qualified, adverse, and disclaimer. Okay, so what exactly is qualified opinion? Modified by the name itself, that okay, unmodified is clean opinion that financial statement give a true and fair view and are prepared properly in all material respect. That is what auditor is having an opinion about the financial statement, and that was our goal since from the beginning. And what exactly is modified? We have been talking about material misstatement here and there. If there is material misstatement, basically what does that mean? That financial statement do not present fairly. Okay, so now if there is one material misstatement, but it is isolated, it is material, it is gonna affect the decision of the intended user, but it is isolated, not pervasive. Okay, what is pervasive? So it affects the entirety of financial statement. So if a material misstatement is isolated and is pervasive, not pervasive, so in that case, the auditor will issue a qualified opinion. Okay, but what if it is pervasive? Affects the whole of financial statements. What's going to happen when they? So then the auditor is going to issue adverse of opinion, material but pervasive. Okay, and what about scope limitation? He is not able to obtain sufficient appropriate audit evidence, and this matter is also pervasive. So that is also going to result in disclaimer of opinion. The wordings would be like audit was conducted, but okay, we were not able to obtain sufficient appropriate audit evidence, so we do not give an opinion. So that is basically disclaimer of an opinion, and this is based on audit evidence. So there would be a case when on the basis of audit evidence not having sufficient or appropriate audit evidence, but if that case is not pervasive, then too the opinion is qualified. Okay, so this was the brief. When you have audit opinion, ISA 700 unmodified opinion, and we have this further on. So then there is ISA 7, and there are different sections. We have key audit matters. ISA 705 is modified opinion. This disclaimer, all those comes under this. And then we also have emphasis of matter paragraph and other matter paragraph. So this is how the audit report is structured. So if I talk about key, how does it look like? So first of all, we have the title as usual, independent auditors report. Then we have the addressee. to the shareholders. Okay, do not write management, address it. Then we directly jump on to opinion and basis of opinion. Okay. Then we have key audit matters, and this key audit matters is basically, I'll just get you the glimpse. Key audit matters are communication. As you remember, we had communication with TVCWG, matters picked up from the communication with those charged with governance that in auditors' professional judgment are of great significance. And key audit matters paragraph, key audit matters section is compulsory for listed entities. Okay. Then we have emphasis of matter paragraph and other matter paragraph. This relates to financial statements and this is not related to financial statement. If anything is properly disclosed, okay, there's no misstatement with, but it is properly disclosed and auditor in his professional judgment wants to get attention of the user, then that particular thing is included in emphasis of matter paragraph. And other matter paragraph is non-financial data. So basically, like previous year's audit was conducted and the auditor issued an unmodified opinion. Now, if the auditor thinks, okay, this shall be included and this year's opinion was modified, so he'll just include another matter paragraph and say the previous year's auditor's opinion was unmodified. Okay, so this is how it looks like. And then there is material uncertainty related to going concern. There is a separate section for it. We'll discuss about what exactly is going concern, but when there is material uncertainty related to going concern, management needs to disclose that. Even if it is properly disclosed. When it is properly disclosed, then as usual, auditor will give an unmodified opinion, but he needs to include a separate material uncertainty related to going concern paragraph because it's of significance important. And this is done so when everything is all right. Okay. Otherwise, the opinion could be disclaimed as well because there is scope limitation and management is not ready. Got it? So this is how it looks like. Okay. See, the completion phase is basically standing back when the audit is about to get completed. So first of all, we have final review is perform overall analytical review. Remember we also do perform analytical review at the final stage. Does the financial statement picture perfectly cohere with everything learned about the business during the audit? Okay, from previous year we had this data, but when the audit is near completion, we have the recent data, right? So definitely we can use analytical procedures for our final review. And does it coincide with what we understood about the entity? Then uncorrected misstatement. At the review stage, must be assessed individually, all the misstatement that the auditor found, and in aggregate. Severe small unadjusted items like in inventory, accruals, receivables can collectively exceed performance materiality. That's why we had performance materiality, basically safety buffer, or clearly indicate a pattern of management bias. Then comes written representation. Formal management confirmation. This is really important. The absolute rule, they support but never substitute for other independent evidence the auditor should obtain. Like it is one of the evidence, but you should not substitute that when other evidence or is supposedly you are supposed to also obtain. A refusal to provide them indicates a severe integrity issue. And then we'll see whether a disclaimer of opinion or adverse of opinion is required because that questions management integrity. So this is all done at the completion stage. Then comes subsequent events. Okay, so that directly coincides with IS 10 adjusting and non-adjusting event. So this concern, we have a year-end reporting date and we have date of auditor's report. So any event happening between this, auditor has an active duty, okay, to keep on assessing if there are events after reporting date. So adjusting events provides evidence of condition existing at the reporting date. So if the conditions were present at the reporting date, for example, after the reporting date, a debtor went bankrupt. Okay. For example, so it's not like he was all fine up until the reporting date and then he suddenly went bankrupt. obviously he would be having some liquidation issues at the reporting date. So if he was having liquidation issues, that is basically your evidence. Okay, he was having a liquidation issue. So it was present at the liquidation, so that automatically makes it an adjusting event. Okay, so for example, consequences required adjustment, like whatever write-off is required, you have to make changes to the financial statement. So requires adjustment of the numbers in the financial statement. For example, a large customer entering liquidation shortly after year end, proving the receivable was already impaired at the reporting date. So this automatically becomes a adjusting event. And non-adjusting event is relates to conditions arising after the reporting date, like requires disclosures if material, but absolutely no adjustment to the year-end number. For example, a factory fire or a bank refusing to renew a facility after year-end. So conditions did not exist at year-end for these cases. So in that case, if this is material, I believe a factory fire is really material. So in that case, a disclosure would be required. If the management is not, willing to disclose it, then is also a misstatement. Okay, and definitely it's material, so it's material misstatement. We have to communicate with the management that you have to disclose it. Okay, and then it would have its implication on the auditor's opinion. Clear with this? What are subsequent events?
Yes, sir.
Perfect. Now comes going concern. See, what happens is you might have, in the beginning of when you commenced your commerce stream, we have been taught that we always assume a business is going concern, right? बिजनेस इज गोइंग कंसर्न इट मीन्स ये चलता रहेगा चलता रहेगा चलता रहेगा. हम वो सोच के बिजनेस स्टार्ट नहीं करते कि कल 2 साल बाद बंद हो गया तो क्या. वी ऑब्वियसली अज्यूम कि ये चलता रहेगा. ठीक है, बट ऐसा हमेशा रियलिटी में नहीं होता. लाइक ऑब्वियसली देर आर अनसर्टेनिटीज इन रियल लाइफ, सो दैट if any particular thing that is related to business that questions your going concern assumption, you would naturally assume that the business is going concern. But what if there are liquidity constraint, you're not able to pay anything? What if there is weak cash generation? What is debt convenient breaches? Basically, if there's debt convenient breaches, so you are not gonna have refinance. If you have refinance, that is basically your arrangement. Okay, so management needs to prove it. Lawsuit exposures, inventory overstatement to the foreseeable future. The concept is, can the entity continue in operational existence for the foreseeable future? So management has to assess that for at least 12 months. So auditor rigorously evaluates the assessment and assumptions. For example, in case of Horizon, will the rising post-year end warranty claims combined with strict band convenience? Here, convenience is a very major link to gearing aggressively threaten Horizon's ability to continue as a going concern, because in future they might face severe liquidity issues. So if refinancing is not available, so that is material uncertainty related to going concern. So you, as management, you have to properly disclose it, and if required, you even have to change the basis of accounting. From normal accounting, you have to go to breakup basis as if the business was to be liquidated. And depending on the situation, it will have an impact on auditor's opinion and report as well. Because if there are material uncertainty related to going concern, then there's going to be a different section about it. Okay, so clear with the concept?
Yes, sir.
Yeah, perfect. Now, reporting logic, question 1, is the problem a material misstatement or an inability to obtain sufficient appropriate audit evidence? So either you have material misstatement or you did not obtain the evidence. In both the cases, if the issue is isolated, then it's gonna be a qualified opinion. Okay. If it's pervasive and material, in case of material misstatement, then it's gonna be adverse. An inability to obtain sufficient appropriate audit evidence, and it is pervasive as well. So that's going to be disclaimed. Got it?
Yes, sir.
And the question 2 is the matter pervasive? Does it affect the financial statement as a whole? That is basically pervasiveness. Okay. And then, as discussed about emphasis of matter and other matter paragraphs are purely communication devices. They never substitute for a required audit modification. They are communication devices. Audit opinion is untouched. Got it?
Yes, sir.
Yeah. Now comes the decision tree. First of all, issue identified, material misstatement. So is the issue a material misstatement? Material but not pervasive. Then as usual, qualified opinion. Material and pervasive, then adverse opinion. What if, or is it a lack of sufficient appropriate audit evidence? Material but not pervasive, as usual, qualified opinion, only the bases are different. In that case, it was material misstatement. Here, there's a lack of sufficient audit evidence, but it's not pervasive. That's why we are having qualified opinion. And material and pervasive, that's disclaimer. C, always remember, if disclosure is adequate, but users still need highlighting. So consider emphasis of matter or material uncertainty related to going concern section, not a modified opinion by default. Always remember you are an auditor. You are concerned with what is required, what is reported. So if there's a mismatch between two, then that is material misstatement. You are not there for assessing, oh God, the business is, liquidating and so on. So you are just concerned with financial statements, whether what is required and what is reported, if there is material misstatement or not. If anything goes wrong with that, then you have to report on it and form an opinion over it. You are not an investor to think you okay, the gearing is not very bad, so you start on including all of those in your report. Got it? So never confuse yourself. Okay, the business is not doing good. Auditor has nothing to do with it. He is an independent practitioner. Okay, he's just concerned whether material misstatement exists or not, or whether materiality and material uncertainty related to going concern exist or not. Okay, so clear till now?
Yes, sir.
Yeah. Now comes material misstatement, not pervasive. Qualified opinion, meaning except how, as discussed, once we have addressee, then sorry, title, addressee, and then opinion, and then we have basis for opinion paragraph. Okay, why do we exactly qualified this particular opinion? So here, if there's a qualified opinion, so except for the effects of matter, the financial statements are fairly presented. Like that, apart from this particular isolated issue that we discussed on the basis of opinion paragraph, everything is fine. What about material misstatement and pervasive? In that case, it's an adverse of opinion. So here, the misstatement is so widespread that the financial statement as a whole are misleading. That is how the auditor is going to respond. Unable to obtain sufficient appropriate evidence, material but not pervasive. So then also qualified. So scope limitation affects a specific area but not the entire field. What if unable to obtain SAAE, sufficient appropriate audit evidence, material and pervasive? Disclaimer of opinion. The auditor cannot form an opinion. If adequate disclosure of material uncertainty related to going concern is made. But in that case, unmodified opinion as usual, clean opinion with separate MUR, material uncertainty related to going concern section as discussed, that is required. The matter is highlighted, but the opinion itself remains unmodified. Okay, got it?
Yes, sir.
Yeah. See, assertions are basically, is it real, occurrence, completeness, valuation. Evidence is basically, can we prove it? Confirmation, inspections, recalculation. Completion, does it make sense? Aggregate misstatement, going concern, and reps. And opinions, what do we tell the public? Qualified, adverse, disclaimer, clean. The independence auditor report is the public manifestation of every test, count, judgment made during the engagement. Okay, got it?